It's no mystery the consumer is strong.
It's very clear that consumers are beginning to slow their activity.
At the end of the day, this is all about the labor market.
I think there is enough support from the labor market to prevent the U.S. consumer from completely rolling over.
Eventually, consumers will come to the realization that things are a lot more expensive.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Nothing quiet about this summer. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Your equity market right now totally unchanged on the S&P 500. Here's a cheat guide. If you're overseeing an economy, the second largest in the world, if you're worried about the data, don't report it. If you're worried about the market, ban selling. Lisa, the latest news out of China. We've seen these kind of headlines before. Chinese authorities, according to our reporting, asking some investment funds this week to avoid being net sellers of equities.
This coming with reports that they're recommending that people not say anything negative about the economic trajectory. So if you don't trade it, if you don't report it, then does it happen? And the answer is, at least around the world, yes, especially given that the data they've been reporting consistently has been worse than expected. So then I guess just, in absence of it will make people think everything's gotten a lot better.
Let's put some numbers on that worse than expected. The expectations on Wall Street around growth in China has changed radically. JP Morgan, just back in May, had a forecast for growth for GDP in China, 6.4% for this year. That's been cut to 4.8%, a 4 handle from a 6 handle in just a number of months.
And there are signs that the PBOC, the People's Bank of China, are starting to respond in some way, but it's not clear what they can do to really generate some sort of confidence. The fact, I just want to go back to this idea that they're not reporting the youth unemployment rate. And I was looking at some of the reports about how this is being interpreted. And a lot of people, even in the mainland, are saying, we're not dumb. This isn't positive for sentiment. We see what's going on. And, young people cannot get jobs.
Well, let me give you the official line once again. For those of you that might have just come back from vacation and missed the official line, you won't receive youth unemployment. I don't know how long it would take to receive it again, but ultimately, this is the explanation from the National Bureau of Statistics. The labour statistics, quote, need further optimisation, and Lisa, more research needs to be done on whether students looking for a job before graduation should be counted in the labour statistics.
So if you're trying to come up with an estimate for the economy, what do you use? Do you gain confidence? If you don't have confidence, do you use on-the-ground types of measures? Or like Apple, there was a report today, they're moving more of their manufacturing out of China. Do you accelerate that with this feeling that there's a clampdown and something that is not transparent and not available for the projections and the things necessary for an open business?
So the growth in China, not great. The growth in the United States, still talking about an upside surprise on US retail sales. The data just better than expected. Is there such thing as too much of a good thing?
People yesterday were gaming out something like a 5% GDP in the sort of just for the third quarter alone based on these retail sales. I was looking at Jason Furman, who had some estimates to that degree. Yes, basically, is the answer. I mean, this is what's been fueling this sense that there is going to be hotter inflation. The Fed's going to have to hold rates higher for longer. That said, there are people saying that the money's going to run out. But they've been saying that for how many months?
Months and months and months.
And it hasn't happened.
It's the 3-month rolling recession forecast. It just keeps rolling. Keeps rolling.
At some point, people are going to have to run out of cash, I assume. But their balance sheets are good. Now they're borrowing money for it. Student loans are coming due. They don't have to pay because for 12 months, they're not going to get penalized anyway. So these are some of the sort of offsets that people are pointing to that could keep consumption going. Again, it comes down to the labor market. Everyone keeps saying, unless the labor market breaks, this is kind of going to be how it's going to be.
Neil Kashkari of the Minneapolis Fed speaking yesterday. The work's not done. Look out for the Fed minutes a little bit later on this afternoon. Lisa will give you the time of that. Here's the price action on the S&P 500. Equity futures on the S&P right now, just about unchanged. They're going absolutely nowhere. For 4 consecutive days, yields have been climbing on a 10-year. Over those 4 days, up around about 20 basis points. This morning, down about 3. Lisa, your yield, 417.58.
Today, we do get some more retail sense from the earnings. Target comes out in about a half an hour. TJ Maxx comes out at 7:30 a.m. Very curious to see whether they really represent some of the positive gains that we heard yesterday in the data. So far, the retailing sector is up more than 30% year to date in terms of the S&P, far above what other people are seeing. So this has been a place of strength. 8:30 a.m., we get building permits and housing starts. This, to me, is the biggest mystery. How long can we see this kind of upward momentum, especially given that home builder sentiment did fall off a little bit yesterday? John, home builders, those shares are up 47% year to date.
Go back to last summer. It's even better than that. It's amazing.
I mean, I'm just trying to wrap my head around how long this can continue with mortgage rates where they are. And Fed minutes, you were asking about that, 2 p.m., they are coming out. I did some calculations. Since July 26, 10-year yields are up more than 30 basis points, as you were saying. It really has been entirely focused in the long end at a time where there suddenly is much more dissent on the Fed. That is what I want to see in the minutes.
Interesting to see the 2-year breach 5%, just for a moment, a heartbeat, after retail sales yesterday.
Gaming out how long rates can remain high. It's less about whether they're going to raise rates again and how long. And that has been the honest theme, and you've seen that priced into the market.
Let's see if we see that theme in a minute, so a little bit later this afternoon. Let's get your market conversation started. We can do that with Ben Gutteridge, the investment director at Invesco Solutions. Ben, fantastic to catch up with you, sir. Underweight bonds, overweight equities. Just walk me through that overweight on stocks right now, Ben.
Well, a pleasure to be with you and really enjoying your conversation. I think the premise behind that overweight equities, not that it's without risk, is on the basis that inflationary pressures can continue to moderate. And as much as that feeds into both supporting consumer spending power and grants the central banks, Federal Reserve, the flexibility to, stay pat on interest rates, cease hiking at least. I think that sort of mix, resilient growth, moderating inflation, less hawkish policy, I think that can continue to support equity markets into year end.
Ben, why do you think that will continue in a favourable direction, given that some people believe to get inflation back to target, growth's got to take a hit?
Well, I think if you look at some of the key components to inflation, you look at the goods element, and, we'll often refer to things like used car prices, or indeed you look at the supply chain index, the frictions within the supply chains, all of that feeds into the idea that inflation can moderate. And then you look at the sort of the shelter component. And again, you look at sort of lead measures such as sort of levels of rents. And again, that suggests that inflation can continue to moderate into year end. Inflation forecasting, of course, not without risk to, what's happening in labour markets, in wages, could well undermine that view. And of course, what we're seeing in energy markets as well. But on balance, I think there's enough in what we're seeing in terms of shelter and goods prices to support a further see inflation continue to move lower into year end.
So why are you underweight bonds, Ben?
Well, I mean, there's a bit of horse trading because we believe equities are the go-to asset class. So it's got to come from somewhere, and therefore, bonds is a natural source of funding. But within that, of course, there is like a risk that growth really disappoints, and maybe we get maybe we get inflationary risks, maybe we get deflationary risks. But on the basis you get deflationary shocks and equities get punished through that route, then we want to have some duration in that underweight bond component, sort of a bit of sort of portfolio management nuance in that. But because you're underweight bonds, we want duration to hedge against the overweight equity.
So perhaps just using cash to extrapolate out into a little bit more risk. I'm looking right now at the year-to-date returns and then the month-to-date returns. The NASDAQ leading this sort of correction light, I want to say, down about 5% this month. Is it a buying opportunity? Is it a pause? Or is this a reallocation within the market under the hood to different areas?
Well, I think, like on balance, you would say it's a buying opportunity. Look, there could be an even more attractive buying opportunity in the coming days, weeks, months. But on a 12-month view, as I said, on the basis we think certainly 6 to 12-month view, on the basis that inflationary pressures can moderate and growth can be resilient, then these parts of the market, I think, would perform in that environment. Not a one-for-one relationship, as we know, between bond yields and sort of loosely defined sort of tech stocks. But there is something to it. And on the basis that yields might move lower from here on the back of lower inflation, think it looks like a reasonable buying opportunity, but maybe not the best buying opportunity.
Alita, I was going through the price action yesterday, looked at stocks, difficult session, looked at credit, barely noticed. Yeah. 375 high yield spreads near the tights of the year. And
we've heard people say they're hiding out because you get both sides of everything, and these companies have sort of termed out their obligations, and so it looks like it's pretty good.
Everybody's worried about a maturity wall on the horizon, but they're not really worried about it.
It's not yet.
There is this belief that they're going to reduce interest rates before we get there over the Federal Reserve. Can you take comfort in that?
Me, personally, I
Sure.
can't take comfort in anything. You know that. I mean, I just am going to worry about everything, and I'm going to suggest that at that point, how bad does it have to get for the Fed to cut rates And what does that mean for the credit component of some of these companies? In other words, yeah, the maturity wall is further out, but if things deteriorate before then maybe people will demand a higher premium.
Ben, there's always something to worry about. Work with me here. Let's worry about this. There is this maturity wall out there in the distance. It's out there in 2025. We know that high yield companies would ideally deal with that at least a year beforehand, and markets are going to start thinking about it too. There is this belief that the Federal Reserve starts to cut interest rates in the middle of next year. We've seen policy start to shift, at least pricing of policy start to shift in a more hawkish direction. Ben, when do you think there is a less favourable way of looking at high yield credit and the ability of some of these firms to refinance next year, with the idea being that the Fed's going to hold for a whole lot longer than maybe some people think?
Well, I'm afraid you can't sort of strong-arm me into a position of great anxiety. I'm afraid I would be of the mind that, many of these businesses have done a good job at terming out their financial position, meaning the debt obligations aren't going to be so onerous moving forward. And as we get into 2024, I think when you're thinking about mild recession type environments, inflation continuing to moderate, maybe they can at that stage next summer be something of a move lower on interest rates, which would give markets and businesses some ease about the impending refinancing challenge that might lay ahead thereafter.
Right now, Ben, when you look out, what is your main potential risk? I'm not going to strong arm you into a great place of great anxiety.
You're going to try.
But I'm going to try. So what is your sense of kind of what could be out there that could make you reassess at least this gradual disinflation that a lot of people seem to be betting on?
Well, the disinflation narrative reversing, if heaven forbid we have a replay of 22, and inflation surprises to the upside on an ongoing basis, and central banks turn more hawkish, that would be pretty bad news for our strategy, for positioning in general, markets in general. And unfortunately, we are sort of seeing signs of reviving inflation in commodity markets, labour markets staying strong. Even falling inflation itself can bring about its own demise in it, that it supports demand and can see a reacceleration of goods prices. We're seeing longer end of bond markets, TIPS yields sort of move higher. So, that is not an insignificant risk to the core view.
Hey, Ben, you're a strong man. It's good to catch up. Ben Gutter is there.
Thank you.
Of Invesco Solutions. Thank you, Ben. Thank you very much. Neil Dutta of Renmac might have things to say. He pushed out this quote in the last couple of days. I'll share it with you. It's worth thinking about. You either believe a period of below potential growth is necessary to quell inflation, or you don't. He goes on to say, given the tailwinds from housing, motor vehicle and airplane assemblies, inventories, consumption, the US economy is nowhere near a below potential growth situation. He's concerned this Fed is embracing this soft landing story too soon.
That they're embracing in a very quiet way transitory or immaculate disinflation, that these are some of the post-pandemic normalization effects. And Neil Kashkari, you mentioned him, and I was looking at his actual comments yesterday, and he said, I want to see convincing evidence that inflation is well on its way back to 2%. We don't need to get there tomorrow. We can allow it to gradually get there over time. How gradually? Does it matter how long? I mean, at what point does it become embedded and concerns and all of this stuff? And, these are some of the questions, and it goes to Neil Dutta's point.
You're going to be sick of talking about this in about a week. Jackson Hole, a week away.
I will never be sick
Got
of
3 days of talking about
trying
this.
to strong arm people into
non-stop
feeling
in Jackson Hole, Wyoming. Looking forward to that coverage with you on Bloomberg TV and on Bloomberg Radio. TK's taking a little bit of a break. Hopefully he'll be back before the weekend and into next week to cover Jackson Hole for you all. Coming up a little bit later in the next hour, Stuart Kaiser of Citi on this equity market. In about 20 minutes, we'll get numbers from Target. Just another flavour of what's happening in retail in America ahead of Walmart tomorrow. Live from New York City this morning. Good morning.
If David Solomon were to be fired today, I think the stock would actually go down. When I talk to investors aren't saying, oh, get rid of David Solomon. They're really asking the questions you're asking. Hey, does the media impact their performance? I'd say no so far. Having said that, David Solomon has to earn his job every day. And so I can come back in 3 months or 6 months and he doesn't get the job done. I'll be on the other side.
That was Mike Mayo, the head of US large cap bank research over at Wells Fargo, speaking earlier this week on the future of the Goldman Sachs CEO, David Solomon. Some fresh reporting this morning from the team at Bloomberg, including Bloomberg's Sri Natarajan and Shonali Basak, on the future of Goldman Sachs CEO, David Solomon, and his possible successor, President John Waldron, writing the following: as bitterness festers in the ranks this year over Solomon's leadership, Waldron is being pressed by colleagues to pick a side, beat his own path to win over disgruntled executives, or risk being seen and as an affable clone of the CEO. Joining us now, I'm pleased to say, is Sri Natarajan of Bloomberg. Sri, let's start there. The push, the pressure that this guy is under to pick a side. Has he picked a side?
No, I mean, there is no outward indication that he is going out there and saying that he's breaking ranks with the CEO. At the same time, it is clear that as he does his listening tour across the firm, he is listening to the frustrations and acknowledging the frustrations. The challenge is that he is in a very difficult spot. John Waldron, when he started his career at Bear Stearns, was tied up with David Solomon in the early 90s. For the last 30 years, he's climbed the Wall Street ladder right behind David Solomon, first at Bear Stearns and then at Goldman Sachs. Now you have a situation where it's clear that he was the presumptive CEO in waiting. He is the sole president of Goldman Sachs. And 2 years ago, if you had to ask anyone when the next succession happens, whenever that might be, tomorrow, day after, 2 years from now, John Waldron was the most likely one, was the obvious one. It doesn't appear that obvious anymore in the middle of everything we're seeing and the voices we're hearing from inside Goldman.
I remember the previous obvious successor to Lloyd Blankfein. That was Gary Cohn. You mentioned this in a story this morning. How do you avoid being Gary Cohn at Goldman Sachs?
It's a big risk. It's not just a Goldman Sachs risk. It's a risk in corporate history. Anyone who has been a long-time number two, unfortunately, runs a risk of always being seen as a deputy. At the same time, let's look at what the criticisms of David Solomon are. It is not a CEO who's run the firm into the ground. In fact, it's not at all the case. The stock's up quite a bit. The core investment bank has done well. They've done well with clients. They've had some successes in alternatives, fundraising. And therefore, if you had to think that John Waldron is in sync with David Solomon on strategy, that's not a problem. A lot of the criticisms about Solomon emanate from the personality. They are personality criticisms, which have a major bearing. But you don't hear the same things about John Waldron, who clearly seems to be much more well-liked across the firm.
Just to build on that, you quoted a recruiter in your piece saying some people would choose loyalty over ambition. But I think many people would choose ambition over loyalty. And spoken like a true Wall Street aficionado, I'm curious from your vantage point what it means to have loyalty, right? How split is the firm? How much has David Solomon lost the room?
Think about it, at least to start with, a little bit like the House Freedom Caucus. It might not be the majority of the partnership. It might not be the majority of the group, but it is a loud, vocal group that has influence across the firm. And these are not irrelevant executives who are making this charge. There are a lot of people, if you look across the ranks of the top 20, 30, 40 partners of the firm, not many of them will openly tell you that they're completely behind David Solomon and they'd like to see him for 5 years. So yes, there is clearly a split. Yes, there is clearly a schism there. And that's the challenge that Waldron faces.
Mike Mayo of Wells Fargo came on and suggested that part of this disgruntled feeling within the ranks has to do with the fact that investment bankers weren't paid as well last year, even though they really led the firm in terms of profits. Does that ring true to you?
That is interesting. If you go back 10 years, for the longest time at Goldman, at any other Wall Street bank, the constant criticism we heard about the media was we are the ones portraying Goldman executives, banking executives as greedy whiners. All that they care about is money. But last week, there was a really damning magazine story about what is happening inside Goldman Sachs. And the spokesperson of the firm was the one lashing out at the rest of the partnership at Goldman Sachs, saying they are all complaining because they're upset about pay. Or at least that was the undertone of what he said. That is not something you hear normally. And therefore, I'm sure the partnership, I'm sure the people who are upset with strategy will tell you it's not all about that. They will say it's not about that at all. But the fact is, yes, there have been strategy missteps. The market did turn, which did bite into profits and therefore did also take a big bite out of pay.
Can I just ask this question? It's something I've been thinking about. If no one likes this guy internally, based on media reports, how did he get the top job in the first place?
It's very interesting because remember when Lloyd Blankfein was stepping down, he had set up a proper succession race. It was a two-horse race between David Solomon and Harvey Schwartz, who, after a little bit of time on the beach, is now the CEO of Carlyle. And at that time, the assumption was it was always likely going to be Harvey Schwartz. He was seen as Lloyd's guy. He was a trader. And everyone just automatically assumed it was going to be Harvey. Lloyd and the board did pull a rabbit out of the hat. David Solomon was a surprise pick, and he had business success. He had done well on the investment banking side of things, which is a business that he was running. He had improved the returns profile there. So when he was named CEO, it wasn't as if there was great disappointment. But over the last 5 years, especially through the pandemic, and as the markets have turned after that, it's clear that a image about David Solomon has been etched in stone inside Goldman Sachs, and it's going to be very hard to turn that around in a day or two or a month.
If you're running this bank, I imagine you're less concerned about how your image is being played out in the media. You're more concerned about clients. Are clients concerned? Do investors really care, based on what the stock has done, based on what the firm has done and how they've executed under Solomon's tenure?
Two important constituencies, the clients and the board. We have no indication that the board is out there saying, what shall we do about David Solomon, right? In fact, we also know that Goldman Sachs trotted out comments from its lead independent director, Bayo Ogunlesi, to its staff saying that he's happy with stock performance. He thinks it has done well relative to rivals. So they have tried to signal subtly, or maybe not that subtle, that the board is behind David Solomon. The question about clients, though, gets riskier. We've had a lot of conversations with corporate CEOs, with private equity firms, with hedge funds, where they are increasingly asking us questions about what is the mood about David Solomon. They tell us that a lot of their meetings with Goldman Sachs people is spent on asking about what is happening inside Goldman Sachs and then moves on to more important constructive things that they're actually there for. So there is clearly some concern and uneasiness among clients. And if that grows, that is when you see a real problem. There is no indication that there is a real problem to David Solomon's position as CEO. Yes, there is a lot of griping, and yes, there is a lot of dissatisfaction. That doesn't necessarily translate into David Solomon not being the CEO of Goldman Sachs.
John, when we were talking a lot about Goldman Sachs, I was wondering, how are the banks doing? We've seen yields go up. They typically are supposed to do better when yields go up. They've done really poorly this month. Goldman Sachs shares are down about 6%. But if you take a look at Citigroup's shares, they're down about 8%. And you could see the Bank of America stocks are down a similar amount. JP Morgan down 4.5%. I mean, it's sort of surprising considering the environment. No?
They've outperformed the sector, haven't they, under his tenure?
That is important. Over the last 5 years, Goldman Sachs has done well relative to peers, right? It is behind Morgan Stanley, and that doesn't make anyone at Goldman Sachs happy. They're a distant second.
We can blame Gorman for that, right?
You should blame Gorman for that because, look, he has run a drama-free firm. Like it or not, that's the reality about Morgan Stanley. But behind Morgan Stanley, there's Goldman Sachs. Jefferies Pure Play Investment Bank has also done way better than Goldman Sachs. But after that, Goldman Sachs and JP Morgan, and then come the rest. But over the last 2 years, the stock has been stagnant. A lot of the stock price growth has been driven by the expansion in book value. Earnings has grown, driven by the part of the firm that the Goldman management wasn't keen to tout, trading and investment banking. They wanted us to look at consumer banking, at wealth management, asset management, hoping to get a higher multiple. Investors haven't rewarded them for that. And that's important because a key pillar of David Solomon's strategy was to make sure that this stock gets re-rated. The stock advance is tied to the growth in earnings from the old Goldman Sachs, from the part of the Goldman Sachs that is really good at what it does, from what makes Goldman Goldman, its bankers and traders.
This speaks to exactly what Mike Mayo said, which is this is a bunch of traders who don't feel like they've been rewarded based on how they've executed over the last couple of years. And the more and more we have this conversation from the people that know what's going on inside the bank, like you three, the more I walk away feeling like this is just deeply personal and not strategic.
There is a strategy element to it. At a place like Goldman Sachs, where we point out in the story, that is a firm where even the use of a red pen on a trading floor is seen as a harbinger of bad luck. Their mistakes are magnified.
I feel the same way about red pens. Don't
you?
you?
Are you serious?
Oh, yeah, throw them away if I see them on a desk.
Why?
Yeah, every time. Same
I
reason.
don't care. I'm not superstitious.
Sri, thank you. Great reporting, sir,
Really?
alongside Shanali. Thank you very much.
out?
I don't do that. No, don't use red pens, Bremo.
Why?
It's bad news.
Why?
It's what teachers do. Angry teachers. They sort of like,
It's like trauma from grade school?
I wouldn't call it trauma.
Like it was like
From New York City,
-3.
maybe. This is Bloomberg. Let's get to the price action for you on the S&P 500. Totally unchanged. The story of the week so far. What Monday gave us, Tuesday took back. Totally unchanged now, basically, on the Nasdaq, on the S&P 500 for the week. The S&P 500 slightly negative over the last couple of days. Early days The week is still young, but poised for a third week of losses on the S&P 500. Potentially, if we did close here, just something to think about, 3 weeks of losses would be the longest weekly losing streak of the year so far, Lisa. So that, I think, paints a picture of how good 2023 has been to date.
It's been tremendous, and it's been led by the tech share. As I was looking at what was leading some of the declines, and it is the tech names, but it's also some of the meme stock types of names as well. So it is the sort of like froth that was built into the market over the first half of the year just being taken off. And we keep hearing buying opportunity from a growing number of people who are trying to take advantage.
Repeatedly.
Into
the bond market we go. 2-year, 10-year, 30-year, shaping up as follows. The 10-year yield at a new high for the year in yesterday's session. That new high just short of 4.27 on a 2-year, had a little bit of a sniff of 5%, then backed away after breaching that level very briefly after retail sales, breaching that level for the first time since early July. This morning, your 2-year back to 4.90, down 4 or 5 basis points on the day. The 10-year down to about 4.1719. We're down about 4 basis points on a US 10-year. I want to turn to the FX market. I know it's only Wednesday, but again, if we closed here, 5 weeks of losses for the euro, potentially. That would be the longest weekly losing streak going back to March 2022. The euro this morning, slightly stronger, trying to do something about that. 109.20, we're positive by 0.1%. We've talked a lot about the earnings so far this week. We've had numbers from Home Depot. They didn't really impress too much. Walmart tomorrow, Target right now. The headline on Target that you need to know, they've cut the outlook for EPS. The new range for full-year adjusted EPS is $7 to $8. They had seen previously $7.75 to $8.75. The numbers for the quarter, Lisa, I believe a miss on the top line, but a beat on the bottom line. The stock is higher here by 4%.
Which is surprising considering that they cut their full year adjusted earnings per share. So I'm curious to go through some of these numbers. But they did talk about same day services growing about 4%, led by a 7% growth in Drive Up. They're talking about digital comparable sales. I'm curious to see, again, if this is basically another kitchen sink. Can they do that? How many kitchen sinks can they have before people are kitchen sinked out?
Can you buy kitchen sinks at Target? You can buy everything else, can't you?
I'm not sure whether you can buy kitchen sinks, but you can buy the soap to go on the kitchen sink.
Target right now is up by about 5 or 6%. Walmart coming up tomorrow. We'll recap those earnings in just a moment. Under surveillance this morning, the top story, China authorities asking some investment funds to avoid being so-called net sellers of equities as the markets drag lower. Several large mutual fund houses were told to refrain for a day from selling more onshore shares than they purchased, according to people familiar with the matter. So they're not banning selling per se, Lisa, but they're trying to make sure people don't sell too much.
How do you have a market, and at what point does this really scare away a lot of foreign investors? There's a tension where the authorities in China have been trying to lure back some of the international businesses that have been skittish because of the increasing hard line that they've been taking. What does this do to that? If you don't have the confidence of where they're going to allow share selling, how do you then operate a business in a way that is similar to how you do in the rest of the world? And this is a real issue that we keep hearing from executives.
They did something similar in early 2016. The question I would ask is, does this kind of thing work?
No.
Does it work?
I mean, the issue is work in what way, right? Because does it work for market sentiment, market feeling? No. Does it work for at least not perpetuating the bad news among the population? Maybe. Is this targeted for a domestic consumption, as you said yesterday, versus an international one that maybe has less import at a time where they're trying to triage, given some of the numbers that they've been putting out?
The latest on China this morning, the equity market has been a big drag, down for 4 days. I believe the CSI 300 over that period, down about 4%. Fed minutes due out a little bit later this afternoon, 2 p.m. Eastern time. The account of the latest policy meeting likely to show that a minority of officials favoured holding rates steady through the rest of the year. Lisa, I think a lot of people are on that page. Kashkari pushing back, saying the work is not done. They've just been flirting more recently, though. I'm thinking of John Williams, the New York Fed, just embracing and engaging in this conversation about cutting interest rates next year. I know it's not to ease policy. It's just about stopping policy becoming more restrictive. But once you start engaging in that conversation, are you sending a signal?
The irony is they are sending a signal and the market's not getting it. They're getting the opposite one, which is that perhaps the Fed is going to be blind to a persistent inflation that's going to remain hot and that's going to force them to keep rates higher for longer. There's this feeling right now that there is a patience on the Fed to wait, that they can take a look at the data as it comes in, and they can sit and they can hold on September and even November and just watch it percolate out without the fear of a policy error? Does anyone push back against that? That's what I want to know at Jackson Hole. Is anyone saying, no, actually, now is the time to act if you believe that inflation cannot come down unless there is preeminent weakness in the economy?
The annual get-together, about a week away.
Yeah.
About a
Are you
week away.
excited?
Oh, yeah, can't wait. Thrilled about this stuff.
Do you have a
Going to sit in the
hat?
freezing cold.
Yeah.
A cowboy hat.
Yeah,
No,
yeah.
that's a Mike McKee thing. I don't think they
like
suit me at all.
bears.
With bears?
Yeah. Like just coming around saying
You're
hi.
trying to scare me about bears? Is that what you're trying to do?
I don't really have to try.
What are you doing? No,
I'm
petrified
trying
of bears.
to, strong arm you into a state of professional anxiety.
It's a safe default position to be petrified of bears.
No, they don't want to hurt you. It depends what kind.
Sure. Grizzlies?
Grizzlies,
No, thank you.
Basically.
Yeah.
But,
No,
they're not
thank you.
going to come by. They're Fed officials. Like,
Okay. All right. You're too excited about this. Like a child going on vacation. It's work, Bramo.
Oh, I know.
It's not a
It's
vacation. Let's turn to this story just to wrap things up for you. The death toll from Maui wildfires topping 100, but only 5 victims have been identified so far. Just deeply depressing statistics in the last 24 hours. The cause of the fire still under investigation, but increasing scrutiny has been over the power equipment as the possible source, leading to a record slump in shares of Hawaiian Electric. That stock, Lisa, hammered over the last couple of days to start this week.
It's such a tragedy, and the fact that there are reports of people on the island being asked to provide DNA samples so that they can identify more people as they go through the rubble. The question for me on a longer-term basis, once we get beyond the tragedy, which a lot of people will suffer for their lives, there is a question of what this means for insurance policies, what this means for businesses that are going to operate in some of these high-risk environments. You think about all of the floods, the fires, the hurricanes, and you start thinking about insurance policies that are getting revoked in places like California, Florida, and now you have to wonder what's going to happen with some of them in these certain areas.
Super serious issues. We'll try and keep the coverage going for you on Bloomberg TV and on Bloomberg Radio. Let's turn the conversation to Jennifer McKeown, the Chief Global Economist over at Capital Economics. And Jennifer, let's start with the economic data out of the United Kingdom. We've seen the wage growth figure, record wage growth, looking at core CPI out of the UK this morning. Pretty tremendously sticky in the view of many people. Jennifer, there is this belief that maybe the Bank of England needs to go even further. Many people from the outside looking in, including the people on the inside, focused on what's going to happen here to the housing market. Can you run us all through where the effective rate is on the average mortgage right now in the United Kingdom and how painful that's going to be in the next 12 months as it climbs higher?
Yeah, okay. Well, that's, I think, a really key issue for the UK economy and for the Bank of England, and I think feeds into this debate about how long interest rates are going to stay higher for. Mortgage rates, new mortgage rates are already up at about 6%, but given that most people now in the UK are on longer term 2-year fixes, whereas previously we were more on variable rate mortgages in the UK, that's feeding through fairly slowly. We think that probably around 2/3 of those with outstanding mortgages haven't refinanced since the MPC started to hike interest rates. So looking over the next 6 months or so, it's very clear that more people are going to need to refinance on far higher rates than they have currently, and that's bound to have implications for the housing market. House prices have already fallen by about 5% in the UK, and we think there's probably a further 5% or so to go, so a 10% peak to trough, which will have knock-on implications for the wider economy, the upside of that being that it should ultimately help to bring inflation down.
10% of a decline is actually, it sounds like a lot, and it is a lot for many people. But I'm actually surprised at how tame it is relative to certain prognostications about a 30% decline, at least in the U.S., if you were to look at the price that people pay relative to their incomes and how much it's gone up. Given the fact that CPI came in hot yet again, does this basically mean that the Bank of England has more room to hold rates higher or even raise them much higher than you previously thought without causing over an incredible amount of pain among the population?
Yeah, I mean, there's already quite a lot of pain, even with wage growth as high as it is. Inflation's still marginally higher, and people are really feeling the strain. You can see that in the consumer spending figures to some extent. The bank, I think, will need to hold rates higher, certainly for longer than we expect the Fed to. We think there's probably one more rate hike to come in the UK, and then after that, we think that rates are probably going to stay at these kinds of levels for about a year. The Bank of England's made clear that it expects rates to stay a bit higher for a bit longer to really tame these inflationary pressures, particularly stemming from the labour market. A major issue in the UK, as you'll know, has been this drop in labour supply, which has made the labour market very, very tight and suggests that some of this wage pressure is going to persist. So I think probably about a year of higher rates and a year of pain for a lot of people dealing with that before ultimately a recession brings inflation down and allows the bank to start cutting probably late next year.
All of this sort of highlights a debate that we've been having for a couple of months now, which is, are we witnessing long and variable lags? Or is this showing that rate hikes don't have the same effect as many people expected them to on both growth and on inflation?
Yeah, I think a lot of it is about a longer lag, and a longer lag particularly in the UK than we have seen in the past because of this shift in mortgages. But to some extent, that feeds into less of an impact. If it takes 2 years for the impact of monetary policy tightening to start to hit real people, then it may be that by the time people are needing to refinance, then rates are actually coming down again. So I think this longer lag can also mean slightly less of an impact than we've experienced in the past, but really it remains to be seen just how damaging that this tightening cycle is going to be. I think what is clear is that there is more pain to come, even if rates are already at a peak.
Jennifer, the base case in this country has shifted somewhat to a more favourable outcome. There's just this belief held by a lot of people that we speak to on a programme like this that perhaps you can engineer that so-called soft landing. You can get inflation back towards 2% without a recession. Is the base case in the UK now that they would need a recession at the Bank of England to get CPI back towards 2%?
Yeah, I think we agree with that view on the US. It does look more like a soft landing is going to materialise now. Thankfully, it's very clear that the underlying core rates of inflation are coming down, but there's much less evidence of that in the UK, as we saw in the inflation figures today. Now, it is the case that the UK has lagged behind the US. Same goes for the Eurozone. Inflation was later to pick up, will be later to come down too. So we can take some reassurance from what's happening in the US. But I think the situation in the labour market, both in the UK and the Eurozone, is a bit different. This continued tightness in the labour supply, which is very much a feature of in the UK, isn't the situation in the US, where the labour supply is now considerably higher than it was during the pandemic, and that suggests that wage growth is going to there's going to need to be more action from the MPC to bring wage growth down than there is from the Fed to allow a continuation of the easing that we're already seeing in the labour market.
Jennifer, just what is constraining labour supply in the United Kingdom? What's behind that?
It seems to be long-term sickness, perhaps related to long NHS waiting lists, which really backed up during the pandemic. So it's not something that's going to go away overnight, unfortunately. It's not just a migration situation. Some people have pinned it on Brexit, and yes, migration is playing a role, but I think it's a lot more about long-term sickness. And until these NHS waiting lists have come down, that's going to continue to be a feature.
That is dark. Jennifer, thank you. Jennifer McKeown of Capital Economics. Just another example, Bramo, of working through post-pandemic normalisation. In the UK, it's taken a while. We've got record wage growth and tight labour markets, and we're constrained on the supply side for a number of reasons, including the one that Jennifer just explained.
Dark is the right way to describe it, if that really is what the main constraint is, and how much is that really constraining labor around the world. I was just looking through Target just quickly because I was trying to understand why the shares are up more than 10%, and I'm trying to understand why, since they have a negative outlook for the rest of the year, they had a strong profit, and so maybe that's enough to avoid the worst case scenarios.
Profit bouncing back, apparently. We'll see if that move sticks. There's always a knee-jerk reaction after earnings. I've got no idea what this does around the opening bell. More on that a little bit later. Coming up shortly, the CEO of Hong Kong Exchanges and Clearing. That conversation coming up next from New York. This is Bloomberg.
We've been calling it a shift from made in China to made by China. And I think they're going to pursue strategies that help their companies sell their products globally, largely to the autocratic, resource-rich nations that are shipping a lot of commodities to China. And that'll be kind of the quid pro quo. We buy your commodities, you buy our goods. But I have a lack of faith that even if the Chinese companies do well, foreign investors will do well. I'm just worried that China will do things over time to hurt foreign investors if they see fit.
It's the perspective from Peter Cheer, the head of macro strategy at Academy Securities. Always fantastic to get his view on things, particularly on what's developing internationally. Here's the story of what's developing stateside right now in the equity market. On the S&P 500, equity futures are just about positive, but basically unchanged. Yields coming back a bit, down 3 basis points on a 10-year, 4.1777 on a 10-year yield. But Lisa, the move we've seen over the previous 4 days, it's been pretty fast and much higher on a 10-year.
And it really games out the idea of rates longer, higher for longer, but also of this premium placed on U.S. debt with an increasing number of investors maybe pulling back on the margins. And I think of sovereign investors in particular, whether it's Saudi Arabia or China.
Let's talk about China and let's talk about Hong Kong more specifically. Hong Kong Stock Exchange missing profit estimates today for the second quarter. Sluggish trading, a slow pace of initial public offerings, raising some questions about the future. I'm pleased to say that joining us now is Nicholas Aguzin, the Hong Kong Exchanges and Clearing CEO. Nicholas, wonderful to catch up with you, sir. We want to talk about what's developing on the mainland, but also I have a more pointed question for you. Are you expecting the government to lower stamp duty to boost trading?
Hi, Jonathan, and good to be here. It's you know, the thing that we're most excited about is about what we've been doing in terms of making our market more accessible, making sure that we continue lowering our costs. We cannot manage the stamp duty. I mean, what we've been doing is we lowered the trading tariff for a lot of our participants, and what we're seeing is that the market is very vibrant on the derivative side and a little bit softer on the cash side. But as you know, our results were up 31% on a net income basis, so we're very glad about that.
You can't do anything about it, but have you spoken to the relevant authorities on the issue?
We're constantly talking to all policymakers about how to improve our markets, how to make sure that we make it more vibrant. That decision is something that they do it on themselves, and they take into account all the different factors in terms of like the benefits that there may be, pros, cons, etc.
You'll forgive me for labouring the point and jumping back in, Nicholas, but if we could answer a little bit more clearly as to one, whether you've had that conversation, and two, whether you think it would make a difference. It's just a yes or no. Has that conversation taken place?
Yeah. Yeah, we are not currently engaged in any conversation.
Right now, there is a larger question as you talk to clients, you emphasize what you are doing. Do you get a lot of questions around what you're not going to be able to control in terms of what the authorities are going to do, whether it's limiting how much you can sell versus buy, or what kind of free market parameters are put around share trading?
Yeah. Hong Kong is a very international market, as you all know. There's no restriction in the flow of capital. I mean, we're very exposed to like all the activities that happen around the world, and therefore, I mean, it's the same as like most markets around the world. So, free flow of capital, access to information, free access to information, and what we want to do is to make sure that we continue connecting East and West. That's our core objective, and that's what we've been doing and improving in our market.
How much are you seeing companies and, frankly, investment banks shift to Singapore, which is something that we keep hearing about as an alternative to Hong Kong, just as it gets more connected to mainland China?
Yeah, I do think that during the COVID period, it was a challenging period for Hong Kong. At this point, I mean, I'm not seeing a lot of that. I mean, on the contrary, I do see a lot of people that are returning with the new availability of flights and being able to move around. We're seeing a lot of visitors come in, and we're seeing more and more people coming into Hong Kong. International bankers are coming here, finance companies, hedge funds, etc. So we are seeing this, you know, as a much more vibrant environment compared with the last 2 years.
5 years ago, 10 years ago, a lot of the bankers, the international bankers who came to Hong Kong were from the U.S., from the United Kingdom. Has that demographic shifted? Are you seeing more from other places that are outside of the main European and U.S. markets?
Yeah, we are seeing people come from all over the world. I'll give the example. Last year, we hired our CFO at the Hong Kong Stock Exchange that came from Brazil. He used to be the CFO of B3. So people are coming from Southeast Asia, from the Americas, Europe, and so the demographic continues to be very international in Hong Kong, with people coming from all over the world.
Nicholas, you're going to love me by the end of this conversation, but I just want to ask another question, if that's okay. We're reporting that Chinese authorities have asked some investment funds in China this week to avoid being net sellers of equities. Can I just ask you if you're familiar with that request?
Yeah, I'm not aware of any of that, and essentially, our role is to have robust, transparent markets in Hong Kong. You can come and hedge exposure, whether it's buying, selling, totally free market, and totally available for investors to hedge their exposures, whether it's a net short or a net sell.
Do you think those kind of decisions undermine transparency?
Again, I'm focusing in our own markets. So our own markets are very, very transparent, very liquid, and right now our focus is to allow the markets to determine the prices.
Does it frustrate you that in many cases your home market is conflated by what happens on the mainland? Does that make doing business increasingly difficult?
Our market is affected by geopolitics. It's affected by the global macro environment, and we've been trying to make sure that we provide even more tools for investors to hedge some of those, positions that they may have, and that's why you see that our derivatives business actually, in the last quarter, had a record number. We traded 1.4 million derivatives per day. So the role that we have is we want to be a risk management center for those people that want to invest in China, also for people from China that want to invest around the world. And we think that we perform an amazing service at doing that.
There is a belief at the moment that investing in China is becoming more difficult because of a lack of transparency. We've talked about the youth unemployment rate no longer being published. There are official reasons for that, and there are reasons that the majority of people that we speak to believe, which is that it's high and they don't want to report it anymore. Does that undermine some of the volume coming through your exchange that would typically take exposure to China, which now sees some of these issues as, quote, uninvestable at times?
I think that the world is massively underinvested in China. And similar, China is massively invested the world. So what we see is that over time, even though we may go through some periods that are certain lows, over time we're going to see more and more investments coming into China, because China represents 18% of the global GDP. And today, when you look at international funds, it's only about 1 to 2%. There's 60 to 70% of the funds that today have zero investment in China. I don't think that is sustainable over time. Now, we may see some ebbs and flows because of macro situation, geopolitics. But if I have to bet on the long term and the growth opportunities, that is a massive opportunity. So you may see some periods of time where volumes go down and others that go up. And we've seen that over the last couple of years. But at this time, if I have to guess what the best thing is to focus on the medium term, long term, and in the long term, I don't have any doubt.
Well, we appreciate the update this morning, sir. Thank you for being with us. Nicholas Saguzin there of Hong Kong Exchanges and Clearing, a gentleman in a difficult position at the moment, given, Lisa, what's developing elsewhere.
Especially because there's a lot that's out of his control. And there's a lot that people are saying, exactly, and there's a lot that people are saying about the dynamic that is causing an increasing number of businesses to at least raise questions, or some of the investment banks in the U.S. to reduce their presence.
Open, transparent, credible, ready for business. That was the pitch of Hong Kong, right?
The fact
is that still the pitch now? Is that a credible pitch?
The fact that it was not the mainland. And yet, clearly, the increasing ties have challenged that proposition.
Stuart Kaiser of Citi on the stock market coming up very shortly. Your stock market this morning, a welcome snooze. A snooze, a breath of fresh air.
Now.
Given some of the volatility recently, equities going absolutely nowhere on the S&P 500. Yields come back in by 3 basis points. Your 10-year, 417.97. From New York this morning, good morning.
It's no mystery the consumer is strong.
It's very clear that consumers are beginning to slow their activity.
At the end of the day, this is all about the labor market.
I think there is enough support from the labor market to prevent the U.S. consumer from completely rolling over.
Eventually, consumers will come to the realization that things are a lot more expensive.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
I love Bob Dole. That quote there, eventually. It was like eventually 6-9 months ago, and we're still sitting here and saying eventually the consumer will weaken. Live from New York City this morning. Good morning for you all. This is Bloomberg Surveillance on TV and radio alongside Lisa Abramowicz. I'm Jonathan Ferro. Your equity market right now unchanged on the S&P 500. Lisa, eventually we'll see some weakness in the US consumer.
This seems to be the mantra, and now increasingly I think there is a new feeling in markets that maybe eventually isn't going to come unless there is some sort of break in the labor market. And that, I think, is the tension that you feel in the bond market right now with yields up so significantly on the long end.
Earnings season. Are we starting to see signs of it? Just a little bit. We've talked about the airlines a few times, JetBlue, Southwest, the domestic players. Are we starting to see signs that maybe the domestic demand is starting to tail off just a bit?
It depends where you look, because you see certain companies that have serious pricing power. You think of Coca-Cola and Pepsi, and clearly people are willing to pay for shrinkflation and whatever else. But other places, not so much. So at what point do you just see people prioritizing their allocations of cash versus wholesale rebellion against pricing? You know, this to me, I think, is what we're looking for. And it's a spotty picture. It's not happening fast enough.
I know people who drink Diet Coke in the morning for breakfast.
Oh, yeah?
Do you know those people?
Yeah.
Gross. Absolutely
really?
Gross.
Are you trolling somebody who's watching right now?
Maybe.
Yes.
But gross.
Okay.
Disgusting.
You do you.
You do you, apparently. Let's get to the price action on the S&P 500. If you do drink Diet Coke for breakfast, you do you. Equities unchanged on the S&P. Yields down by 3 basis points on a 10-year, 417.97. A new high for the year, though, on a 10-year yield, Lisa. That new high is about 427, just short of that in yesterday's session.
Yeah, just a shocking move on the long end today. We did get earnings from Target, and we're trying to understand the move, which is up, considering the fact that their earnings projection going forward is down. But they did have a surprise profit, even though they did see sales decline. We're trying to parse through it. We get TJ Maxx at 7:30 a.m. After the bell, we get Cisco on the tech side. 8:30 a.m., this is the other mystery. Okay, on one hand, retailers, how long do they have pricing power? On the other hand, builders, how long can they keep building homes and selling them for higher and higher prices? How much does sentiment start to fall off, given the fact that home builder stocks are up 47% so far this year? And at 2 p.m., the Fed minutes come out. And I am curious about whether there is a comfort with this feeling of waiting, whether we start to get a little bit more dissent among Fed officials at a time where the market is gaming out higher inflation and higher yields for longer. This has to cause a little bit of angst at a time where there is a belief, or there used to be a belief, that back in the day, the longer inflation remained high, it would become embedded.
There's an obvious split on the committee right now. Just officially, they're very good at covering it up every time there's a meeting. But there is an obvious split. Bowman's talking about more hikes. Kashkari's saying we're not done. New York Fed President John Williams is doing the rounds, engaging in the prospect of rate cuts next year for very obvious reasons. I get all that. He's just trying to say we don't want policy to tighten as inflation falls, and we don't want it to become more restrictive. But when you start engaging that conversation, when you start embracing the prospect of a soft landing, that's a very, very different view to where we were 12 months ago.
Which is a reason why people are trying to game out whether inflation can remain higher, because this is going to be a more dovish Federal Reserve. Do we see that pushback percolate out and that dissent percolate out a little bit more next week? It kind of feels like maybe, because at a certain point you can't just sit and wait. You get behind the times, and you have to get ahead of it.
Jackson Hole, a week away. Joining us around the table here in the studio, Stuart Kaiser, the head of US equity trading strategy over at Citi. Good morning, Stuart.
Good morning.
How long can Goldilocks last? HSB's question, not mine. HSBC just asking that question seconds ago. They say continued disinflation and stronger than expected growth in many DMs argues for a continued risk-on stance. Does it?
I think in general it does. I think, big picture, if the labor market in the U.S. remains strong and core CPI continues to ease, I think that's a good backdrop, for risk assets. I think the issue we're having now is, frankly, expectations. If you look at what's happened over the last month, you had a reasonably solid earnings season, but the average stock that beat EPS was unchanged on the day. You had, a solid payrolls report. The market traded off. You had an easy inflation print, and the market was flat. So, there's a lot of good news out there, but the market, I think, has become a little callous to it, which is kind of not good for risk risk reward in our view.
Michael Hartnett talked about this, Lisa, over at BofA in the fund manager survey. Their line was basically bear positioning was a strong tailwind for risk assets in the first half, not the case in the second half. Their fund manager survey, you mentioned it yesterday, least bearish since February of last year.
Yeah, cash allocations coming down, and we heard that to start the show. Basically, take the cash, and you might as well put it into risk, because why not? You might as well get the upside surprise if the economy is strong.
You put it into tech at the start of the year. You did, Stuart. Many other people didn't. There was that pool of negativity to feed on to drive tech higher after a brutal year in 2022. Are you sticking with that trade?
You know, it's a tough call right here. I think, yes, as a base case, we still like tech and growth. We still think that can work because we do ultimately expect the labor market data to begin to weaken. And I think in that environment, that's kind of where you want to sit. Obviously, the last month has been pretty tough for that trade, particularly because yields have risen, pretty sharply. And that's impacted tech, I think, more than other sectors. And also this expectation story. If you're worried about high expectations, that's clearly very acute in the tech space. So I think you are fighting expectations, you're fighting performance, and right now you're fighting higher yields. But if you do think economy can weaken, and that should hopefully put a cap on yields, then I think tech is a place that you want to be in that case. But certainly the past month has been a tough ride for us.
Can we just talk about quickly, just pause, cash on the sidelines? This is sort of the misnomer that everyone keeps talking about. Oh, there's so much cash on the sidelines, all these people who aren't invested. Cash is great for some people if they're earning 5%. So at what point can we say the cash on the sidelines has been used up?
I think it's a great question. I mean, if you look at retail money market balances, those are up $600 billion since April of last year. $600 billion is a big number, right? But to your point, you're clipping a 5% coupon on that. And clearly not all of that 600 will go into cash. A lot of that's probably come out of traditional bank accounts and got into money market funds to get that yield. So I think the question is, to release that money, what has to happen, right? Either you need to get yields lower, so that 5% isn't as attractive, or you need to have equities continue to perform the way they are, and you get sort of a FOMO, situation on the equity side. It does feel like equities are topping out a little bit, so I think it's going to be hard to dislodge that money.
To the sentiment point, at what point do losses become self-fulfilling? At what point do losses spur a question to this whole Goldilocks, to John's point, and FOMO feel that we were hearing about for the past couple of months?
Look, I mean, if equities start to move a little bit lower, that's going to dent sentiment. I don't think there's any way around that. Tech has performed poorly, but frankly, the S&P isn't that far off its highs. So, it's interesting. Last year, in a high volatility environment, the moves we've seen recently would have not really registered, right? But July was the lowest realized volatility month that we've seen since December of 2019. So you get into August, you get a little bit of a blip, and it feels, I think, a little more painful. But yeah, I think one of the things we were a little bit worried about is a lot of folks were very defensive in hedging earlier in the year. That hedging did not work out. It cost a lot of money in terms of premium paid. The market's probably less well hedged today, than it was probably 3 months ago. So to your point there, if we do get some losses, the market is going to be a little more surprised by it, or probably a little more disrupted by it than it might have been earlier this year.
Let's finish on where the negativity is now. It's in China. Everybody that comes on this show is so downbeat on what's happening in the country at the moment. The data's bad. The data you can see, you're not going to see much more of it on the youth unemployment side. I've got no idea when that changes. The data this week basically led to a policy response by the Chinese central bank to cut rates by the most, I think, since 2020. This is typically the time to lean into Chinese equities when people are so downbeat on what's happening there. Is this that time?
We're not there yet. I think at least me personally, we're pretty cautious on China. But I think there's three aspects to the China story. There's 2 weeks ago, everybody was celebrating China's exporting deflation. This is going to help the Fed, right? But that sort of ignored the flip side of it, which is you're losing a global growth impulse. This week, the discussion is much more about the growth side and to what you were discussing earlier, which is a sentiment issue. And I think the sentiment issue, frankly, is what's going to keep people out a little bit. Foreign investors, I think we're not happy with how they were treated by China over the last couple of years. And I think it's going to make money, kind of slow to re-engage in that space. So I think, to me, the sentiment is very hard to predict. The growth versus inflation trade-off, I think, really just has to do with what the market narrative is at any given point in time, right? If 2 weeks ago was an inflation narrative, it's good. Now it's a growth narrative. It's a little bit bad. But I think we're generally, being fairly cautious about putting money into China. The flows that we've seen are much more options-based, high payout type stuff, limited risk, type flows going going into China. And we've discussed this in the past. The evolution of that Chinese trade this year has been, or over the last 12 months, has been very, very fascinating. And right now, I think people are a little bit cautious to put money to work.
There's a question about whether or not to put money to work in Chinese equities. There's another about the read-through effect in the United States for companies that are leveraged to China. And then just more broadly, I think about the fact that this wealth manager missed payments on several of its products, that you're dealing with a housing market that doesn't see a light at the end of the tunnel. At what point does that have contagion that percolates outside of China?
It's a good question because, I think initially, or stage 2 or 3 of the China trade was, I'm going to own Europe and I'm going to own luxury goods that sell into the China consumer, right? So, certainly those type of stocks would be under a little bit of pressure given the lack of spending growth that we're seeing in China. So yeah, it's an impact. If you look at the foreign direct investment in China, it's come off a little bit. U.S. companies are clearly not putting money, directly in there for luxury goods, and you'd probably throw Apple into that category and Tesla as well. The domestic demand has been a headwind. So yeah, it is a risk, and I think that just gets into this global growth narrative of when does the benefit on the inflation side get outweighed by the sort of detriment on the growth side?
Well said. I'm just looking at Target on my screen right now, slightly distracted. It's up by 8.5%.
I don't get
off
it.
the back of this.
Do you understand it?
One of those stories that if you told me the earnings before they came out and then said, guess what the stock price is going to do? I'd be like, well, they've cut the outlook on profit, so that's not great.
That's what I
But we like
too.
the second quarter rebound for profit.
I personally think this is just where the expectations have been set. Because if you look at those shares, they're down considerably on the year. So at a certain point, if they're not hemorrhaging money and throwing all in, some negative news, I guess it's positive. I can't really read it any other
Stuart,
way.
what can I learn from a move like that?
Well, the thing is, you say Target. If you said Target, it would be
It's so much better,
more.
isn't it?
It would be much more understandable the type of move. But look, this is the important part of earnings, right? It's what happens with the consumer. We had tech early.
Sell to tourists over in China, couldn't they? Target, part of LVMH, some kind of collab.
Yeah.
What were you said? Did you say they sell sinks?
No, you were the one that said
Oh,
that.
I
I
was
said
asking.
they sell, I know, the soap that goes on sinks. I can affirm that.
Nice.
Yeah.
Okay.
News you need to know.
Stuart, good to see you. Stuart Kaiser, City. Thank you. Thank you, kinda, right? Kinda.
That's
but
great.
not really.
I get to go buy a sink.
Every guest that comes on this show, they're like, thank you.
Yeah, sort of.
I think
I'm going to run away now.
I'm like, thank you, and I'm kind of sorry. Equities on the S&P 500 shaping up as follows. Let's check out the equity market and the bond market too. Yesterday, the bond market, Treasury yields, post-retail sales in America had a little sniff of 430 again. Didn't get there. Backed away on a 2-year, breaching 5% for the first time since early July. That also backing away. Yields lower by a couple of basis points on a 10-year this morning. 418.56 on a 10-year. In the equity market, negative on the S&P 500 by 0.1%. Coming up a little bit later in the next hour, we'll catch up with Joseph Quinlan of Maryland Bank of America Private Bank. Looking forward to that conversation. And at some point this morning, in fact, maybe we do that now, sneaking in a little bit of football. Lionel Messi, is that 9 goals in 6, Stuart?
Yes.
Have you got the subscription
right to him.
to Apple?
I have not gotten the subscription.
Are you tempted to buy it because of what he's doing?
No, I'm not.
I've thought about it. Yesterday, I thought about it. I considered it.
This actually bothers me because you tweeted over the weekend the Premier League schedule, and all the games are on Peacock.
I know.
It drives me nuts when they put them on Peacock.
I know. It drives me nuts when I don't know where they are. So that was like my public service announcement for everyone else who gets confused about where the games are.
But don't people get bored if somebody is so dominant in the industry? Isn't it sort of like an unfair fight? Isn't it better when there are rivalries and there's actually somebody who can go against him?
Yes and no, but it's nice to watch one of the world's greatest ever players just on cheat mode in the MLS, just having fun and just finding it easy. I'm enjoying that. I'm enjoying the highlights. I'm this close to paying for a subscription.
So you haven't
I'm not
actually
there
watched
yet.
the whole game.
I haven't
there you
done
go.
It.
So yeah,
I haven't done it yet.
It's basically
I'm
a
being open and honest
celebratory,
about
like
that.
sort of, victory lap. Rather
the whole
than,
point of him being here for the likes of Apple was to get people like us to subscribe to MLS. And
okay,
I'm not ready yet.
But as a long-time watcher of football, isn't it sort of highlighting to you the lack of competition in outside of Europe?
Yes.
I'm being very diplomatic.
But I will say this too, that's changing. Saudis are making a big push. No idea what's going to happen there. The power of this country. If this country decides to flex its muscles with this sport going into 2026, it could be huge. If it decides to flex its muscles, you're just getting a little hint of that now. And look at the attention it gets. I'd like to see a whole lot more going into the next World Cup, and hopefully we do.
Public service announcement.
Hopefully we do.
Ferro.
From New York, this is Bloomberg.
We have more to do with inflation, though. It's just about 3% now. It's predicted to go lower than that. We're near the lowest point in over 2 years. And at the same time, the pay for low-wage workers has grown at the fastest rate in 2 decades. Wages are growing faster than inflation. Folks, that's Bidenomics.
President Biden speaking at an event in Milwaukee. There's a bit of a PR tour on the 1-year anniversary of the Inflation Reduction Act. Janet Yellen leading that effort in many ways in an op-ed today in the Wall Street Journal. Here's the quote for you. 1 year ago, President Biden signed the Inflation Reduction Act into law. It's the boldest climate action in the nation's history, one that pushes us forward towards a net zero economy by 2050. The Treasury Secretary going on to say, over time, the Inflation Reduction Act will drive down the cost of clean energy technologies, Lisa, which will boost their adoption and reduce emissions globally.
Is it a coincidence that President Biden is in Milwaukee doing this tour? I'm just saying this is coming a week ahead of the Republican election, the Republican campaign for the primaries and the debate that's going to be held in Milwaukee. You just have to wonder.
They've been really strategic about where these events take place, you know.
Yeah. Oh, yeah.
Really strategic.
To send a lot of messages.
They've picked out certain politicians who voted against this, turned up in their district, that kind of thing.
Yeah, people who were against this and then have benefited tremendously from it. And a lot of people have felt the money in a positive way. So they are trying to go around. I don't know. It feels like exactly what you said, basically, you know.
Oh, it's right on.
Yeah.
I think you're on the money. I do. I think you're on the money. AMH joins us now. It's happening. She's back. Anne-Marie Hordern, Bloomberg Washington correspondent. AMH, welcome back. I think that was 2 weeks, something like 2 weeks. But you're lucky. TK's not here, so you're not going to get bullied about this.
All the more power to you.
Good for you.
You go.
For bringing that European work ethic to Washington, D.C. Anne-Marie, let's talk about this PR tour.
It was under 2 weeks, for the record.
I know. Okay.
Come on. It's a wonderful
What was
thing.
it? A week? 10 days?
A week and a half.
A week and a half.
Days.
Okay,
yeah.
2 weeks.
It's
cool. Anne-Marie, this PR tour, can we talk about how deliberate they've been about where they choose to go to deliver some of these speeches?
Yeah, absolutely. You just mentioned, obviously, Wisconsin yesterday. This is coming just days ahead of the Republican primary debate. We're going to have a flood of Republicans going into the state, touting how they see the Biden agenda working and how they feel that it is not working in terms of the economy and advancing the country forward. You just had the Treasury Secretary in Nevada. These are obviously key swing states that Democrats are looking at ahead for 2024. And the issue the Biden administration faces is that time after time, poll after poll, there was just a recent CNN one that shows that more than half of Americans don't think the economy is moving in the right direction and is still rising costs that they are feeling. And when it comes to the Inflation Reduction Act, which Biden recently quipped that maybe he shouldn't have even called it that because it didn't really explain what he was trying to do for the American economy, less than 3 in 10 Americans, according to a recent Washington Post poll, even really understand what it means. Less than 3% actually are the only ones that understand. Sorry, it's the majority that do not understand what all these tax rebates mean, how you can use them towards your home. So they have a big PR problem, and they realize that, and they're trying to advance it today on the 1 year mark, but also going to key places like Wisconsin, like Arizona, like Nevada to talk about it.
Anne-Marie, when you talk to people within the administration, what is their frustration about getting their message across if, as you say, people are focusing much more on price increases and a feeling that the economy is not going in the right direction?
Well, a lot of individuals will talk about what happened with Obamacare, and really the criticism there was that President Obama didn't go out on the road and sell this economic agenda. So they are trying to fix that with the Biden administration. The issue is the rhetoric is not landing. When individuals are concerned about basic needs, paying for groceries, those costs have risen over the past year, paying to pay gasoline in your car, they don't really want to hear about buying a brand new EV and the tax rebate you can get from that. A lot of Americans could not afford a brand new electric vehicle today. And I think that's the mismatch that what people are feeling on the ground, especially outside the Beltway in places like New York or California, versus the rhetoric that the admin is putting forward.
When it comes to inflation, this president has been one of the most union-friendly presidents in history. Right now, the leader of the United Auto Workers is asking his members to authorize him to call a strike as he negotiates with General Motors and Ford and Stellantis. What is the administration's view? When do they start cracking in terms of trying to pay some of the wage increases versus celebrate them outright as workers gaining against against the corporate profits that they lost out on for so many years?
Well, I imagine this message from the UAW president last night on a Facebook Live is going to cause more consternation in the West Wing than already we have seen. And we do know that the White House is concerned because they said Gene Sperling is now going to be this liaison between the union and the White House, as well as the big three auto companies, to try to come to some form of consensus. And Biden is also already vocally, with a statement this week, urging an agreement. So already you could see the White House is concerned about this. And what you see from UAW is that they're ready to at least have on the table. They want to be able to get their workers to say, yes, you can use as leverage. It doesn't mean they're going to strike, but you can at least have leverage that you will walk out. And time is tough here. You know, we're in the middle of August where a lot of individuals like myself, and I'm sure you too as well, will take these vacations. And September 14th is when the deadline is. So time is of the essence to get this done. I think when you see the White House come out with a statement already this week, they are concerned about this. And there is a line here that really connects these two stories. Biden wants to go out and talk about electric vehicles. The electric vehicle path forward and electrifying the grid is something that has caused great anxiety with the UAW workers, and they do not want to be left behind.
MH, you're hitting the ground running. We're a week away from that first debate for presidential candidates in the Republican Party. How do you think some of this is going to play out on the debate stage, away from the controversy around the former president? How do they get these unions on their side?
Well, already when you speak of the former president, Donald Trump, he saw that window. He realizes the concern the UAW workers have about electric vehicles and what they could potentially be left behind when you see the subsidies coming out from the federal government to help the EV industry. And he said he bashed the Biden administration and he's trying to vie for the UAW workers. Right now, that union, although they endorsed Biden in the last round, they have yet to say who they would endorse for president. So you can imagine every potential candidate, every candidate on that stage next week in Milwaukee is going to want to talk about this and try to vie for their vote.
MH, thank you and welcome back. It's good to see you. Anne-Marie, you've been missed. MH down in Washington, D.C., thank you. This article, this op-ed from the Treasury Secretary Janet Yellen is pretty intriguing. So I did a word search on it. Just search for the word inflation. Comes up 10 times. Yeah. Every single time it's just when she refers to the name of the bill, the Inflation Reduction Act. The whole of the piece is not about inflation at all.
Okay. This is like rubbing in because President Biden came out and said, maybe I should have named it something like, you know,
a prosperous
Invest in
year
America.
for the Inflation Reduction Act.
Right.
And this article is not about inflation reduction at all.
Let's be honest. This bill was not about necessarily targeting inflation so much as investing in certain infrastructure. I mean, even the president has admitted this, that eventually could lead to certain efficiencies, et cetera, et cetera, et cetera. So here is the question. As they try to repitch this, how do they gain the upper hand at a time where, you know, there was a lot of pushback at the time from opponents about the name and about exactly how it was getting through?
Well, this is the rebrand effort, isn't it? It must be frustrating that you've got to keep calling it the Inflation Reduction Act and then talk about nothing associated with reducing inflation.
You know, yes, probably. I would guess that one might assume that would be the case.
You're so diplomatic this morning. Well,
that's just me, queen of diplomacy. I do think that it's going to be a hard diplomatic needle to thread, though, when it comes to some of the labor representation at a time where inflation, not just the Inflation Reduction Act, is a preeminent concern for voters. How do you then dovetail your support for wage increases that supersede what we've seen in decades, and at the same time talk about policies that a lot of union members feel are completely antithetical to their role?
I imagine the candidates on the stage at the debate next week will have a very different definition for Bidenomics, won't they?
Of course.
They're going to get in front of some of this.
And this is going to go back to this question of the blue collar and the Rust Belt and where the votes go, because we saw those go to Donald Trump. We saw those go away from the Democratic Party for the first time in decades. At what point does that continue into a cycle where there's a different leader in the party, potentially?
That first debate, a week away. If you're just tuning in, welcome. Your equity market's slightly negative on the S&P 500. Story of the month in the market, arguably what's happened in the bond market. Yields up, up, up and away. Close to 420 this morning, just backing away by 2 basis points. 418.56. Up next, Greg Peters of PGIM, fixed income. Tony Dwyer of Canaccord crushed me yesterday. You know what the new humble brag is on Wall Street?
What?
Mid-interview, drops in what his mortgage rate is. Mid-interview.
Okay. Do you think that was deliberate, or do you think that that's just, how you took it?
He just wanted to let us know. I think that's the new way of establishing credibility with clients.
I logged it
That's
in.
what I would do.
Yeah.
If you're at home, ask your financial advisor what their mortgage rate is. If it doesn't have a 2 handle or a 3, do you trust them with your money?
Just pro tip. It makes certain people angry when they hear about what other people's mortgage rates are. And if you do that, it might alienate said potential client more than otherwise. Just saying.
I think it's a real question of credibility.
Really?
What do they have? Is it a 2 handle? Is it a 3? Are they responsible with their own money? Can you learn a lot from that? Which is why I think Tony slipped it in yesterday into the conversation. 2 handle. I know it's a 2 handle. You got 2 handle written all over your Brammer. Come on.
It's credibility.
You're a
it's called credible.
2 handle kind of person. Oh, yeah, without a doubt. TK, on the other hand.
It's 11%.
No. Equities right now in the S&P 500. Equity futures are just about negative, basically flat over the last couple of days. Monday was decent. Tuesday was worse. We took it all back. We're unchanged. On the NASDAQ, we're down by about 0.06% on the NASDAQ. Really tame stuff in the equity market. Today, at least. Nothing tame about the last month in the bond market. Let's go through the 2-year, the 10-year, the 30-year, and look at the 10-year specifically. So we're just south of 420 right now. We're down 2 basis points at 418.95. Just some levels for you. Yesterday, really close, just short of 427, following that upside surprise on retail sales. The intraday high for the cycle, Lisa, back in October through 430, which is basically where the 30-year is now. But this hasn't backed away. In fact, it's been backing up, yields up.
And this is reversing a lot of what we saw earlier in the year. It's almost as if what happened with the banking sector absolutely disappeared. A question that I have is, how much is this tied to Fed policy, and how much is this tied to a feeling that there needs to be a greater premium for the United States, given the debt profile and given the fact that there are a growing number of buyers who are diversifying away from the U.S.? And I know this is a constant existential angst that people bat down. It has been a bigger conversation of late.
Let's turn to foreign exchange just briefly. I'll look at 2 currency pairs for you. The euro, which of course has a lot of exposure to what's developing over in China. The euro right now, 109.18. We're positive on that currency pair by 0.1%. Sterling stronger as well by about 0.25% against the dollar. So cable, the so-called cable exchange rate, sterling versus the US dollar, 127.37. Lisa, wage growth record highs. Inflation, core inflation specifically, looking pretty sticky at very elevated levels.
Yeah, coming in hotter than expected. And I was looking at some home price data that came out of the UK this morning, and it only showed prices down about 1% since November. So you pointed to this. At what point do things start breaking at a time where you have inflation high, wage growth fueling it, and growth still hanging in there? This is the surprise for the Bank of England.
Big time. And do they have to go again and again? And maybe some more and hold for a whole lot longer than we thought they'd have to, maybe 12 months ago. Under surveillance this morning, the top story once again is over in China. A Chinese shadow bank, Zhongrong, has missed payments on dozens of products with no immediate plans to make clients whole. Investors are fearing that China's economy is getting weaker and the troubled property sector is not getting addressed, Lisa. Some of those property developers have been absolutely hammered, both equity and debt, and looking at the equity market, a bit of a struggle as well.
Do you remember once upon a time where people thought the contagion in China could have ripple effects through the rest of the global economy? Remember when people talked about the housing bubble that people were saying was developing over in China and saying it was a concern for global markets? And suddenly it doesn't seem to matter. There is a serious risk of financial contagion that people are gaming out in China, and the rest of the markets are shrugging it off. And that, I think, is a fascinating isolation of some of the problems in China. There is a real question, can it last?
Stuart Kaiser raised a good question. He said a couple of years ago you'd welcome these developments because we had an inflation problem. You wanted to import disinflation. He thinks that's starting to turn. You're starting to lean into concerns about growth, and I feel that too. To your point, we're just not seeing it in markets, and I've been surprised by that on mornings where you've had this dreadful data out of China, we haven't seen a bond market rally. We haven't seen commodities dive. In fact, over the last couple of months, if you put it all together, we've seen the opposite. Crude is higher, treasuries are lower, and yields are up.
And yesterday we saw crude actually pull back some of the losses that it had incurred because inventories are tight. And again, this goes down to supply-demand fundamentals. At what point has China truly been isolated from global markets? And at what point are people doing Operation Ostrich?
Operation Ostrich over in China.
Well, over in the global markets, too.
That's the term for the BOJ.
I know, but I absolutely love it, so I had to slip it in. It's yours. I totally stole it from you. I just enjoyed it.
You can write the check later. Fed minutes this afternoon, 2 p.m. Eastern Time. Here's the quote from Neil Kashkari. Let's see if this quote is in those minutes. I want to see convincing evidence that inflation is well on its way back down to 2%. Are we done raising rates? I'm not ready to say that we're done, but I'm seeing positive signs. Does Kashkari get a big stage in a Fed minutes later?
Yeah, but it's unclear what exactly he's saying. He's saying basically everything that we are hearing from Fed Chair Jay Powell, which is, we're not convinced that we're done, but they're positive signs. We're willing to wait for some time. We can have patience. How long can they have patience for? At what point are the moves that we're seeing in treasuries highlighting the fact that people are worried about prolonged inflation, the more that there is even a nod to some sort of dovish pause by the Federal Reserve?
Target or Target?
I mean, it is Target. If you say Target, then you get prices going up.
Target numbers came out early this morning. It was a miss on the top line, a beat on the bottom line. They cut their outlook for the year, but that beat on the bottom line, the profit bounce, apparently driving the stock. Target's up by 8% in the pre-market. Lisa, I know you were looking at TJX as well ahead of Walmart tomorrow. What jumps out for you?
That it beat across the board and raised their full-year forecast, seeing earnings per share in the third quarter of 95 cents to 98 cents, seeing same-store sales up 6%. But the raise of the full-year guidance really highlights, sort of in contrast with Target or whatever you want to call it, seems to justify some of the pop that you're seeing in those shares, up 4.3%. I want to point out that TJ Maxx, caters to people who are looking for discounts, for deals. Are we going to hear commentary talking about people trading down, people looking for deals, or is this a sign of the resilient consumer continuing to go and spend?
The stock is higher this morning. Let's turn to Greg Peters, co-CIO of PGIM Fixed Income. Greg joins us now. Greg, not to talk about what's happening with Target, TJX and Walmart, to talk about this bond market, Greg, a question that we've asked all week. And we've got a different perspective from different people. What is behind this bond market move, Greg, of the last month?
Yeah, so I was listening to your repartee, before you came over to me, and I think I have a very different narrative than the one that you were just talking about. I think it's about growth. The Fed has raised interest rates. Inflation is coming under control. Are they done? I don't know. There's probably some more room left to move higher, but it's the underlying growth element that has driven the bond market, in my estimation, as it's about the shape of the curve, right? So if you believe that inflation is going to remain relatively high, the economy is strong and stable, then the curve has to start to normalize. And what that means is that back-end rates have to move higher as a consequence. So to me, it's all about the strength in economic activity. And sure, inflation, remains above trend, but it's really the growth story.
But if you take a look at that implication, there's some broader market consequences to this. First of all, it means that the yield curve is normalizing up, not down to 3%. And that means that we could have higher rates for longer at a time where this economy can keep chugging along despite rates where they are. Can the credit markets sustain a 5% or 4.5% long-term base treasury yield? Does that wreck some of the math behind the credit bet?
Well, yes and no. So, I think the economy can handle higher interest rates. I think that has been the mistake that many investors have made, myself included, the underlying strength in the economy and the ability to handle higher rates and the benefit of higher rates that you're seeing vis-a-vis the consumer. But you're quite right, Lisa. There's been so many capital structures, whether it's in commercial real estate, whether it's in credit, that have been built on the backs of extremely low interest rates. So as interest rates remain at the higher level here, then a lot of those capital structures really can't withstand that environment. So as a consequence, I think we're in this stronger growth environment. But at the same time, we will see above trend default and distress activity as a lot of these companies really just are unable to to be a going concern with a higher rate environment.
One thing we keep hearing, Greg, is a number of investors say they're leaning into duration because you might as well lock in yields where they are. Getting 4.2% for 10 years looks pretty good relative to what you used to be able to get. Are you saying that there is more normalization to be had if we are going to create a more flat or more normalized yield curve?
Yes, and that's what we've been saying, and I've been arguing that for the past 6 months, as I think it's too early to lock in duration. If you believe that the economy, is entering a soft landing, no landing, whatever landing you want to assign to it, that means rates have to move higher, not lower. And so, the Fed might modulate a little on the margin, take rates down, but not as much as in the price, right? And so for me, rates are higher. I don't see any rush to lock in duration at this point. We're leaning against that and have been leaning against that for quite some time. So we're still short duration as once again, it's growth, Lisa.
I assume you're taking that position, Greg, not because you think we're going 10, 20 basis points higher than where we are. It must be bigger than that. What kind of numbers are you thinking we can get to?
I don't know. There's been a big move already, right? So I don't want to get greedy either. But I think on balance, the tendency will be for higher rates, not lower rates. And so, we've been kind of talking about this range of, 4 to 4.5. But the truth of the matter is it's leaning against the forwards and what's in the price. And what's in the price in the forward space, continued rate cuts, and a lower yield environment. So that's kind of what we're leaning against more than kind of making a call on where rates ultimately settle out. But it's the tendency for rates to be higher that I think most investors are missing, as the regime that we were in pre-pandemic is gone. It's different. And I think the rate regime is different as a consequence. And I don't think investors have accepted that reality or accepted the reality that the Fed also can't easily and readily cut interest rates like they did in the past.
So, Greg, what I hear then is just another way of saying don't worry about the reinvestment risk of sitting at the front end. Is that right?
Yeah, to a degree. I think cash rates are really quite attractive here. I think that's inducing investors to take risk off the table, not lean into it. On the credit side of the aisle, there's tremendous opportunity across the global credit markets. A lot of that opportunity, though, is in safe type of allocation. So whether it's front end type of credit, whether it's structured products, these are safe bets where you earn a tremendous amount of carry. You don't have to dip down into triple C's, take a lot of duration or credit risk. And so take what the markets are giving you, and what the market is giving you is really quite attractive here. So we're extremely bullish on the U.S. economy. Kind of on a long-term basis. We're very bullish on fixed income as well, but you don't have to take a lot of risk in order to be successful. And I think that's the important message that I want to leave with.
Message received. A clinic. Greg, thank you, sir. Greg Peters there of PGIM Fixed Income. If you are just joining us this morning, good morning and welcome. Your S&P 500 is positive here by just 0.02%. We'll turn to retail in just a moment. We'll catch up with Dana Towsey. Looking forward to catching up with her. Carl Riccadonna of BNP Paribas joining us at 8:30 Eastern time, so about 48 minutes from now. Lisa, we've heard that from a few guests, BlackRock's Rick Reeder has made the same point that Greg Peters just made. Those conversations, more and more people having them right now. They've listened to their advisors. They've bought the front end. Cash isn't trash anymore. Just to reverse the kind of thing we used to hear from Ray Dalio. I think he himself has said that over the last few months. And now they're trying to work out whether they should go further out along the curve and lock this in, because people are starting to discuss rate cuts. Greg Peters taking the other side of that in a pretty emphatic way just then.
And basically implying that the market is coming around to his view. And there are a growing number of people who clearly are thinking in a similar way that he is, that maybe this isn't going away so quickly. We were talking about this earlier in the week. If everyone's going long duration, why aren't yields going down? If everyone's saying this is an opportunity to buy, why aren't we seeing that in the price action? And that really does raise the question that more people are getting on board with higher rates for a lot longer.
Well, lots of people seem to be buying Target this morning. The stock is up by 7.7%. We'll be talking about that in just a moment. Dana Towsey of Towsey Advisory Group on retail earnings this week. Home Depot yesterday, Target and TJX this morning, Walmart coming up tomorrow. A wrap of all of that up next from New York. Good morning.
Right now, inflation is coming down. We've made some progress, some good progress. I feel good about that. It's still too high. The good news is the labor market has remained very strong, but it's a little bit of a double-edged sword. Are we done raising rates? I'm not ready to say that we're done. In terms of cutting rates, I think we're a long way away from cutting rates because core inflation is still around 4%. It's still around twice of what our target is.
Neil Kashkari there of the Minneapolis Fed speaking in the last 24 hours or so. I'm tempted not to say this because I don't want to jinx it, but the England women's team in the World Cup in a semi-final, 3-1 up against the Australians, minutes away from completing that semi-final and going ahead to the final to play Spain later this weekend.
Yeah, I expect that half of our audience actually right now is watching that game instead.
Just wanted to squeeze that in.
So if you're not, this is it.
We're in the 90th minute and it's 3-1, so we'll see.
You could wait for the 90th minute.
I'm not watching it. I'm just looking at the scores.
You're not.
I'm doing my job.
You're not doing a full TK?
No, TK actually watches video. I don't watch video.
You have standards.
I have standards. I'm just watching the live score on livescore.com. Dana Towsey joins us now, CEO and Chief Research Officer at Towsey Advisory Group. Dana, great to have you with us on the programme. Target, I guess, beating a low bar because the stock is rallying really hard. Can you tell me just what's going on there? How low was that bar and how much clarity have you got on what's going on over there?
We'll have more clarity after they do the earnings call at 8 o'clock. But I think the real change is the fact that the inventory levels continue to remain very clean. When you take a look at the gross margin, it was better than expected. Shrink continues to be an issue out there, but it's all about essentials, which is frankly much stronger than what you have with discretionary at Target. And it's a world of difference because you had TJX just report better than expected numbers talking about the strength in apparel and accessories. So if you have essentials, that's what's selling, but off price is where the action is for apparel.
Dana, before we get into TJX and exactly what the retail trends are, I'd love your thoughts on what we're hearing more of, which is the social pushback and the consequence on sales. If you look at Target's earnings, they said that last quarter's profits took a hit as a result of the controversy around Pride Month collections of items that they were selling. Dana, we also heard this from Anheuser-Busch. How much is this becoming a theme? How much is this a real potential threat for retailers that hadn't dealt with this kind of thing as much before?
It is a threat, and we've seen it happen to multiple different categories of companies selling consumer goods. Certainly, I think the care and the concern about how you navigate this landscape is something that is new for all the retailers, and I think is only going to continue to become more of a topic going forward. And I think you're going to see these consumer companies even more mindful and planning about what stance they take on particular issues.
Going forward, when you talk about the off-price retailers really benefiting at a time where people are being more discretionary, is that a negative sign for the luxury players, or is it just there's plenty of money to go around?
I think overall, the luxury players are in a world of their own. They have a high-end consumer who has less susceptance to really being careful about their spend. But there's different magnitudes of certainly luxury and aspirational goods, depending upon the price point. The comparisons year over year are very challenging in luxury. And while many of them, even the European luxury goods companies, are lower year over year, when you compare it to 2019, they continue to be up, could be 50% or more. But I think every level of consumer spend overall, we've seen a moderation. And where we're seeing the allocation, it seems like one of the only places in discretionary. If it's any of the events like Taylor Swift or Barbie, that people are buying new costumes or new items to wear to those events.
Dana, just to touch on luxury a little bit more, different regions are performing better than others. In America, it's been disappointing. I'm thinking of Richemont and others too. Dana, recently China have allowed group tours to, I think, the UK and the United States. Some people believe that might make a difference. I want your opinion on that. Based on experience over the last year, does that move the dial?
I think it's going to help. I think it's going to help. I think it's going to help show an increase. I think it's going to help to drive demand. I think you need more than just the tourist groups to truly move the needle, but it should help stem the rate of decline that we've seen from some of those luxury players in the Americas.
A theme I've tried to work on over the last year, and I have to say I haven't had much clarity on it, Dana, but maybe you can help me. A year, 2 years ago, we would see a lot of people embracing buy now, pay later for entry-level luxury goods. What we've learned in the last month or so is that entry-level luxury at certain firms has been hit. Are the two things, in any way, shape or form, tied? Do those dots join up to you, Dana? Have we seen that buy now, pay later bubble burst for luxury?
I think that it has burst certainly a bit for luxury. I think when you think about the headwinds of rising interest rates, you have student loans that are coming up in October. The average household has $6,200 of expenses, and you're going to get an increase of 3 to 8% of spend coming from student loans. On top of that, there's less to go around. And so that's why there's the focus on essentials and a reduced focus on some of the aspirational items.
Dana, just to build on what John was asking about, are you surprised that we haven't seen more of a hit to luxury retailers on the 1-2 punch of certain entry-level buyers stepping away and some issues with China, whether it's restrictions or whether it's the idea of just the contraction that we're seeing in certain aspects of the economy, why that hasn't had more of an effect?
I think some of the aspirational players that are out there, they've added a lot of newness and product innovation. There's extreme demand for newness and innovation, and it's really led to be able to have continued strength. But it's not a world of equals. It's definitely a world where essentially, what's the price you're charging? There's some promotions on some of these items that people can get, and what are you seeing others wearing? What are you going to give up in order to buy that aspirational item? And I think it's definitely haves and have-nots in terms of being choiceful in what spend is on.
So what happens to all of the middle players, the middle tier that don't fall into bargain picking or luxury?
Well, look what we've seen. We've seen it be very challenging out there. We've seen it for apparel retailers like the Gaps of the world. It was encouraging to hear American Eagle the other week talk about the pickup in July. We've seen retailers overall lower their inventory levels, but I think you're going to see these inventory levels continue to come clean because the lower freight costs being a help to the margins, the leaner inventory levels, there's more margin clarity. I think the cleanliness on inventory will be the key to managing through this because you have to keep your balance sheet sound.
Dana, I have no idea how you listen to the call and conduct an interview at the same time, but you can. It's amazing. Dana, thank you. Dana Towsey there at Towsey Advisory Group. We appreciate it. I wish TK was here to tell us all about Stealth Wealth. You'd have to imagine Stealth Wealth is going to absolutely hammer some of these luxury firms, and I'll tell you why. People go to Gucci because they want everyone to know they've just bought Gucci. You go to Brunello, Loro Piana, with no branding on the clothes. You go there because you know the clothes are good and it's a high-quality material. What's Gucci and everyone else going to do now when their value offer was basically the brand across the hoodie or the brand across a T-shirt or the logo all over the handbag? What do they do now?
I'm going to take this a step further. Are you saying that it cheapens their brand because it appeals to a certain aspirational player and then all of a sudden everybody goes more to Stealth Wealth?
I'm saying that they're going to have great difficulty finding a better value offering when their value offering was just a brand, a logo.
Yeah, well, I think that you're seeing that with certain... I mean, Celine, have you seen the price drops on some of the Celine items?
I haven't seen it. They've gone down. Have they cut prices?
I've seen some, yes, on the margins. So you start to wonder at what point is that sort of what people are pointing to. That said, the dispersion that you're seeing, at what point does that become something more broad-based versus just ongoing, dispersation of the economy, right? I mean, the idea that you've got the haves and the have-nots has been an age-old story. At what point does that really feed into the headline figures?
I thought the quiet luxury theme would kick in earlier coming out of the pandemic, that it would be a little bit more modesty after the hardship of a lot of people. But then I guess everyone got sent checks and everyone just went nuts. It was the opposite.
Oh, no, it was the opposite.
I got that so wrong,
Really?
Know.
Well,
I think that's so wrong.
I think that everybody was ready to celebrate. I think that what Dana Towsey said about people dressing up to go see Barbie, if you go see Barbie, theoretically, you could see all of these people wearing, pink outfits and huge dresses and everything that they clearly just went out and bought because you don't just have a shade of pink.
Dress up for
places.
the movies.
100%. You see everybody doing that.
When I watch that at home, would you like me to dress up?
100%. And please send me a video.
I'll wear an Inter Miami football kit with Messi on the back.
Which has the same color.
Represent.
I'm just saying, people want to have events. They want to live. They want to get out there.
Yes,
the Roaring
they should.
20s.
They should. Is that what this is? It didn't turn out that way, did it? People thought it would be. Do you remember that? The Roaring 20s.
Well, maybe it is. Maybe that's what we're
seeing.
seeing.
It might be. We'll see, won't we? Full time, 3-1. The England women's football team beating Australia 3-1. Going on to the final later on this weekend.
Welcome back to another special Western and Southern Open update for Bloomberg TV and Radio from Tennis Channel. I'm Erin Coscarelli. World number one Carlos Alcaraz returned to his winning ways in Cincinnati after he took out Australia's Jordan Thompson. The Wimbledon champion went out early in Canada last week and will be looking to tune up his hard-court game ahead of the U.S. Open. And don't forget, you can watch all the action live at 11 a.m. Eastern on Tennis Channel. I'm Erin Coscarelli.
6 months from now, if rates are still 5+%, we're going to be having a much different conversation than we are now.
We are not certain that the last hike is behind us.
The Fed will have to be more aggressive, raising rates higher and keeping rates higher for longer.
The Fed's not cutting rates until March next year.
A soft landing is like putting a thread into the needle, and the eye of that needle is shrinking.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. Your equity market totally unchanged on the S&P 500. The retail players this morning, anything but unchanged. The likes of TJ Maxx out earlier this morning with some earnings. We've heard from Target as well. Target's a curious one. A miss on the top line, a beat on the bottom line, a cut to the outlook. Check out the stock. The stock off the back of this, Bramo, flying through most of this morning.
But how much of, again, is this just where expectations were? And again, they were the ones that really were slammed earlier this year, even as others did well. And so at what point is this a comeback trade? Because it wasn't terrible. And they actually did eke out a surprise in terms of profitability in the quarter.
It's on to Walmart tomorrow after a series of upside surprises dominated by what we got from retail sales just yesterday, this time yesterday, which sparked and brought back to life that conversation about maybe, cough, I'm going to say it quietly, no landing?
Yeah.
No landing? Are we having that conversation again?
That's what Greg Peters basically said. What does a no landing mean for yields? It means that they're going to normalize up, not normalize down, the way some people were calling to 3%, say, across the yield curve. There is a question here about how to read the nuances, whether we can read in that this isn't going to be a no landing. This is going to be something that does have to ultimately come down with some sort of pain. At the same time, it seems like that's what the data is screaming.
This is why it matters to people. We're going to next week. Jackson Hole, going to hear from a load of Fed speakers going into September 20th. People want to know if that rate cutting cycle is going to begin next year and whether they should lock in their cash savings to longer dated bonds. Lock in those high yields while they're here. I've heard that argument from Lisa Shatter at Morgan Stanley. The pushback from Greg Peters in the last hour is basically saying don't worry about it. People are underestimating how long rates are going to stay this high, and that if you are in the front end, you can pick up 5%, no problem, and not worry about the reinvestment risk down the road. That's a really important debate for a lot of people away from fixed income. Forget all the bond market jargon. If you're at home, you have this big pool of savings, you're getting 5% on it. Are you worried that 5% disappears a year from now?
And we're hearing a real split in terms of people who say that they're going in, and yet yields have continued to climb higher. I wonder whether the Fed is losing its relevance, because even if they come out and they say they're going to cut rates, they say they're data dependent. At what point do you just see inflation expectations go up? We saw that over the longer term. In other words, the more dovish they get, does that just create a more upward tilt to longer term yields if you believe the growth is there, if you believe the momentum can continue?
That's the danger of embracing the rate cutting story too prematurely, too early. When you start to talk about disinflationary trends, meaning real rates push higher and you don't want things to tighten, then you have to reduce the nominal rate. I get it. It makes sense. I understand why you might want to talk about it. But whenever you bring up that conversation, you are sending a signal. And I think that's what you're getting at.
Well, and just to sort of push this to where we're going to see in 30 minutes, we're going to get housing starts and building permits. And that's been an area of incredible strength at a time where the mortgage rate's the highest going back to 2000, 2001. So at what point can you say, okay, this deceleration is enough to bring down inflation if you still see housing prices going up, despite rates being so high relative to the recent history? Again, this goes to the conundrum that I want to hear from Federal Reserve officials, because do they worry about erring on the side of not being hard enough in terms of creating a little bit more pain?
That housing market's dying. I mean, it's just seizing up. Can you imagine working in real estate right now on the residential side of things? It must be brutal.
Well,
it must be absolutely brutal.
You've seen the layoffs in terms of mortgage brokers.
Who wants a mortgage of 7-8%? Who wants that?
Yeah,
Who
well,
can
they're not
afford
getting
that?
it. Although I do wonder if the new mortgage broker is at the home builder because they're extending mortgages that are a lot lower because they have the capital and it's a lot easier to move inventory.
That's where the boom is, that's for sure. Equities right now on the S&P 500, just about unchanged. It's been a bumpy road through the month of August. We're positive here by 0.06%. In the bond market, yields a little bit lower by a couple of basis points, 419.14 on a 10-year. Joe Quinlan joins us now, CIO of Market Strategy at Maryland Bank of America Private Bank. Joe, wonderful to have you back with us. It's been a while, sir. A bump in the road in the equity market. Is that a bump in the road you and the team want to buy?
We do, John, but selectively, because we think there's more bumps coming through September and October. But we want to be positioned for the recovery. You were talking about the recession. I think next year we talk about the economic recovery. So, yes, we're selectively on a qualitative basis buying the dips, but we think there's more volatility ahead, near term.
With all due respect, recovery from what, Joe?
Well, we're moving, the narrative is going to shift from recession to the fact that no landing, and we're going to see growth, I think, pick up in the second half of next year. We're not there yet. We've got to see the goods manufacturing pick up. You just talked about the housing problem. So I think we're going to shift the narrative, like the U.S. picking up steam into this, say, Q2, Q3 of next year, and the recession talk starts to fade.
Is the recovery trade different when you have rates north of 4.5%? In other words, do higher yields in the face of inflation that may remain higher than it has been for numbers of decades going to challenge the traditional thesis of buy the most cyclical stocks?
That will be a challenge, Lisa, for sure. But remember, right now, money market funds sitting there about $5.5 trillion. The average since 1990 is around $2.5 trillion. So there's a lot of dry powder out there for equities and for fixed income, in our opinion. So you're going to start to see that rotation. But we clearly have to see the Fed cut rates, the eyes in recovery when it comes to the recovery. And that's, I think, sets the stage for like more of this liquidity, short-term cash to come back into equities.
Joe, I'm thinking out loud here, so work with me. Someone's got to pay the price for the pandemic. People talk about how strong balance sheets are of consumers. People talk about how strong corporate balance sheets are as well. Someone subsidized a good chunk of that, and that someone was fiscal authorities. Treasury has got to issue a lot more supply. Now, are we starting to see the Treasury market pay the price for that over the last month? Because what's curious for a lot of people, you've had this backup in yields on a 10-year, but credit spreads have stayed really, really tight. And the reason people give for that is that they've been able to go out and refinance, lock in low rates for longer. Treasury didn't do that. Now, I'm wondering how weak this sovereign is on the supply side of things, Joe, and whether the risk this time, the individual, the group of investors that have to pay the price for the largesse of the last couple of years are in the Treasury market.
We're going to see some of that, John, play out. But I do think now you got to widen the global lens a little bit here. Look at the deflation in China. Look at the U.S. outperformance relative to the rest of the world. So I do think there's going to be underlying demand, foreign demand for our Treasury, for our paper. Albeit, having said that, yes, our interest payments on our debt continue to rise. There's talk about our credit rating. That's going to weigh on the market sentiment as well. But I do think at the end of the day, you're right. We're going to have to pay the price. You're already paying it in terms of higher interest payments. And a lot of that flows overseas. But I think at the end of the day, on a relative and an absolute basis, you still want to own U.S. paper right now and into next year. And that takes us to the funding cycle.
I want to pick up on something you were saying, and it's related, the idea of yields that come down next year as the Fed cuts rates. How do we get both a recovery trade and the Fed, who sees the reason to cut rates, even though there isn't a great degree of weakness?
Well, Lisa, I think it's going to come down to earnings. Earnings are going to have to really accelerate. We're looking around 8. Savita, my colleague, is looking for around 8% earnings growth next year. If we get anything above that, then we can push higher with the equities. So you can have the Fed cutting rates. That sets the stage for the rebound for the U.S. And then overlay that with, I just think, kind of the dynamic nature of the economy. You look at the infrastructure spending, the green revolution, energy, you name it. There's going to be places to put money to work, even with the Fed cutting rates, and we'll work through the cycle.
What rate, terminal rate structure are you looking at that keeps you bullish in stocks? In other words, how high could rates go before you start to get concerned that maybe there's a different thesis this time around for stock valuation?
Well, the good news is we're near the end of the Fed tightening cycle. Our colleagues Our economists are looking for one more rate hike in November, and then we kind of level off here. I think, Lisa, the key is here. It's this. How long do we stay at these terminal rates? Is it 5% plus? I mean, that's going to be the issue. I don't think we're going to come down very dramatically. So the longer we stay at 5% plus on the Fed funds rate, the more stress that builds out there and more questions that we have to work through. Doesn't mean we can't work through it, but we do see, the longer we stay at these elevated levels, the risk remain that we have to be cautious.
Hey, Joe, thanks for being with us for the update. Joe Quinnen there of Maryland Bank of America Private Bank on the latest. This is the latest from Citi. The latest from Citi. Here's the line from Andrew Honhorst and the whole of the team on the economic side of things in the research division. Yesterday's solid retail sales reading for July shows spending growth not only holding up, but broadening away from service consumption. FOMC minutes out today. 2 p.m. Eastern time, by the way, may mention the possibility that a sustained expansion would imply a longer period of higher policy rates. All of this, Bramo, into Jackson Hole next week.
And it's sort of what we're seeing priced into the market a little bit. Resilience is this line that a lot of people are pushing back a little bit on. Is this resilience or reacceleration at a time where you had asked, are we going to see services go down to goods or goods go up to services? Andrew Hollenhorst coming out basically saying we're seeing goods go up to services, not the other way around in terms of how much spending there is.
Neil Dutta just on point. I think I bring up Neil every single day at the moment.
He got it right.
The world's just coming his way. I've got no idea who will be right ultimately, but just the conversation is shifting towards him again.
And he talked a lot about home builder sentiment. He talked a lot about the revival in certain goods sectors that had gotten beaten up. This sort of rolling recession shows that the underlying theme is strength. And that is what is perhaps, to Greg Peters' point, keeping yields elevated on the long end.
As far as I know from what I've seen, I don't think we've had a confirmation that Chairman Powell speaks next week, though most people assume he will.
You're still on this. You're still trying to push this narrative, this conspiracy theory.
I think a lot of people want to hear from him. It's no conspiracy theory whatsoever. I just think from my perspective, I expect him to be there. I expect him to speak. I just think he's got enough data left between now and September 20th just to wait and not really say much at all.
If he confirms that rates can stay higher for longer, it's what he's been saying all along. It just has more resonance this time around, maybe. So you might see a market reaction to something that has always been the status quo on the Fed for the past couple of months, and yet this time seems believable to markets.
If you feel like you're in an inflection point for policy, it could go one way or the other. Is that the right time to double down on any message, whatever that message might be?
What if they're not at an inflection point? What if they're just like, we're just going to hang out here?
Truly data dependent?
Yeah.
Live meeting?
What does that mean,
month
though?
After month?
I mean, I want to dig into what that actually means.
I'd like an explanation of that.
Yeah, me too.
How are they dependent on that data?
Which data?
It's just such a throwaway line,
isn't it? Or is it looking
forward?
We're
data dependent.
Yeah, I know.
Yeah, kinda. Okay. If you're just tuning in, welcome. The S&P 500 totally unchanged here, positive by 0.03%. Coming up, 8:30. Watch out for this one. Carl Riccadonna of BNP Paribas following the US housing data. Lisa's going to break that down for you and then get Carl's view on the world and the US economy. Then shortly, up next, Nikolai Tangen of the Norwegian Wealth Management Group. Lisa, this one's going to be fascinating a little bit later.
They account for some incredible proportion of global shares, and they've been incredibly active with a lot of boards because they have to own the index, right? I mean, they basically are certain stock markets. So to hear how they're trying to maneuver will be interesting at a time when you kind of can't avoid a market that is tied to the global economy.
If you're running a sovereign wealth fund like this individual is, and he said this before, your real challenge is not what you own, it's what you don't own. That's what you've got to get really specific about. And back in the spring, he talked about the bad apples. We need to be very careful about the bad apples coming out of the SVB failure. I want to understand what bad apples were there. What did he have to back away from? Then we can get into the weeds around where they are cross-asset right now. I'd also like to know, the BOJ owns a lot of Japanese bonds. They own Japanese bonds too. I want to understand from someone who owns Japanese bonds, why are you holding Japanese debt? What is the reason you would hold that fixed income, that security? Why?
And when they have to trade them, do they call up, Chairman Ueda and say, hey,
right,
do you want some bonds? Because we could sell them to you. Just give us the price because you're going to do it anyway.
That's the flavor of the conversation coming up next from New York City. This is Bloomberg.
the issue we're having now is frankly expectations. If you look at what's happened over the last month, you had a reasonably solid earnings season, but the average stock that beat EPS was unchanged on the day. You had, a solid payrolls report, the market traded off. You had an easy inflation print, and the market was flat. So, there's a lot of good news out there, but the market, I think, has become a little callous to it, which is kind of not good for risk reward in our view.
That was Stuart Kaiser of Citi. Great to catch up with him in the last 60 minutes or so. Your equity market more broadly looks like this morning. On the S&P 500, futures have been unchanged. Bit of a snooze, a welcome snooze after the events of August so far, if you are long the Nasdaq, because the Nasdaq has been a difficult one through August. If you've been long all year, congratulations, well done. You won 2023 so far. In the bond market, yields are lower by a single basis point, 419.93, just going against the grain of the last 4 days or so. We've had 4 straight days, Lisa, of yields climbing.
And a real reset here. You called it the no landing? I think soft landing is what people prefer, because no landing is.
We went from soft to no to hard.
Yeah, exactly.
To soft again.
All we can say is that people are gaming out what it looks like if you have growth that is sustained at the levels that we've seen.
Can we sustain this growth? Norway's $1.4 trillion sovereign wealth fund returning 10% in the first half. That's some better performance, Lisa, after the year before.
Yeah, it's a resurgence after having a pretty brutal year last year. This fund is something that has to own a lot of the broad equity performance. The key is where they adjust and what on the peripheries they invest in as well, whether it's real estate, whether it's some of the more alternatives as well.
Let's get to that now. I'm pleased to say the CEO of that fund joins us, Nikolai Tangen. Nikolai, wonderful to catch up with you, sir. It's always great to get this catch up every other quarter or so. You talked more recently in the last 3 months or so about the bad apples following the collapse of SVB. How many bad apples did you find in the last quarter?
Well, we are continuously trying to find them. And earlier in the year, we were out of Adani Group in India. We have been out of a big Swedish property company, which went bad. We have a whole team who's trying to navigate this and make sure we are out of the biggest trouble.
In the latest quarter, you did get a 10% return, although you dragged down just a bit from certain real estate investments and certain renewable energy infrastructure assets. How do you view your investments, particularly with renewable energy infrastructure, at a time where there seems to be a shift away from that a little bit and towards oil and gas?
Yeah, we got it into our mandate a few years ago, and we were very slow in the beginning because we thought prices were too high. There were too few projects, and everybody were chasing the same project. So we went really slow. I think it's more attractive now. I think the returns you can make in this sector now is better than it was. So I think you should expect our pace to increase a bit.
What about real estate? How concerned are you? There are a lot of people raising concerns that we haven't seen the true reckoning yet, particularly in commercial real estate. Have you been selling? Have you been trying to shift away from that?
No, we've not been selling. We have been staying put. We have just continued to own what we had. I think we have seen a lot of the damage in this area now. We've had rates increasing already. We have seen high vacancy rates. We've seen the whole COVID effect. We've seen the banks having troubles. And so I suspect that we may have seen a lot of the bad news now.
So you think, in other words,
now we also have big exposure in the logistics side, and that those investments continue to perform really well.
You said that you think that a lot of the carnage has already happened. Can you elaborate on that at a time where people say that if the true mortgage rate were really percolated into valuations, you would see some 30% declines, in some capacities more? You think that has already been either priced in or shrugged off because of strength?
I'm not sure all is priced in, but we for sure have taken some pretty big write-downs on our property portfolio. So there's already quite a bit of damage in there.
Nikolai, the concern now, as you know, is over in China. At the start of the year, you and Lisa caught up in Davos, I believe, and we were talking about China reopening and the boom everyone expected. That boom just hasn't materialized. There was a threat to pushing inflation higher, and now they're exporting seemingly disinflation. Nikolai, as you work through the fund right now, how exposed are you to some of those themes, and have you had to pull back in any way, shape or form?
Well, we have a relatively small investments in China, but you're right. The boom in China after the reopening has been less than we expected. Now, I guess the only advantage that we can see of that is there is less pressure on inflation globally on the back of that. But less good news for the Chinese companies.
Could you give me some detail on what exposure you have in China, Nikolai, where that is?
Well, we are like between 3 and 4% in China. And if you add on Hong Kong and Taiwan, we are at 7-8%.
Are you worried about the lack of transparency in the last few days or so when they start to pull back on offering information about youth unemployment. Does that concern you?
No, I wouldn't say the one particular number on youth unemployment has scared me, but we are an extremely transparent fund. We love transparency. We were just voted the most transparent fund in the world. So generally, the more information we can have, the better it is.
There's a broader question about whether we're seeing a sea change in terms of some of the global allocations and some of the views on traditional haven assets. And I think about not only with respect to sovereign debt over in the East, but over in the West as well. People have been talking about the deficit in the U.S. and how that could potentially cause difficulty indigestion among buyers. Is that a problem for you? Is that a concern for you? Have you started to shift and diversify it all away from treasuries and your bond holdings?
No, we have not shifted anything on the back of this.
So are you looking to really understand this or have conversations with policymakers? Is this sort of weigh in on any of your considerations when you look at credit or you look at any interest rate hinged assets?
Well, we have big teams who look at this and who are in continuous conversations with policymakers and so on, but we have not made any changes lately.
Nikolai's done interrogation training, Ramo. Do you not know that?
Are we interrogating? Is that what we're doing right now?
The skill is short answers.
Well, it's good. It's good. And honestly, it's evidently, useful.
Nikolai, the year so
far.
Well,
you know from that theory that a shorter answer on average are more truthful than the long answers.
They're very true.
That's actually true.
Very true. Nikolai, they don't lend themselves to fantastic conversations sometimes, though. So I'm going to do my best just to get a bit more out of you if I can. And Nikolai, the year so far, as you know, has gone from soft landing to no landing to hard landing, back to soft again. There is this idea that we can somehow escape the inflationary threats of the last year without an economic downturn in the United States. Do you subscribe to that theory, or are you in the camp where you're expecting rates to stay higher for longer here?
I think they will stay high for longer. And we've been saying this for a very long time, and I still continue to think that's the truth. Now, one of the new things here is that the link between climate and inflation has become stronger. And we recently seen, the climate impacting harvest prices, such as olive oil, coffee, beef, all these kind of things. But the new thing is really that the change from global warming to global boiling has meant that there are parts of the day where you cannot work across the world. And so productivity in society is decreasing, and that is a new inflationary pressure.
Nikolai,
and so
in
therefore the link between climate and inflation is stronger than before.
In Spain, as you know, for a long time, that's been true. They call that the siesta. Where are you seeing elsewhere that's happening? Where is productivity collapsing because of climate risk? Is it in countries outside of the traditional places we'd look in Europe? In Italy, in the south of Italy, it's been the story you stop work in the middle of the day forever, for as long as I've known. Where is that a new development?
It's a new development in many countries, and we've seen heat waves in Europe that I've never seen before. July is the hottest month we have seen since the world began. So this is new, and it's getting worse.
So
it's not called siesta anymore.
What's it called now?
It's called global boiling.
So from your perspective, for someone who's got to run a fund with exposure to these things, what have you changed?
I just think you need to be more conscious about inflation and take into consideration that the inflation may actually be higher for longer.
OK, Nikolai, we'll leave that there and we'll build on it in the future. Thank you, sir. Nikolai Tangen of the Norwegian Sovereign Wealth Fund. Lisa, on some of the risks around climate, productivity and the inflation story going forward from here, he's been pretty clear on this one. He thinks higher for longer is where we're going to be.
And he thinks that returns are going to be more muted going forward, that it isn't going to be just a straight line the way that has been traditionally. It's a challenge to understand exactly how to game out some of these new trends and to say this time is different in a more material way. They've been trying to do that at the same time that they have to be fully invested. And their goal is to diversify away from the oil largesse of Norway.
I'm going to go. It's all yours now, all right? Coming up on The Open, Brian Weinstein of Morgan Stanley, Sarah Hunt of Empire Saxon Woods, Marilyn Watson of BlackRock. Looking forward to the conversations with them around The Open about the themes will continue around things like higher for longer, whether we are shifting back towards that so-called no landing, which isn't really a thing, but ultimately it means this Fed's going to have to go further. It's the Neil Dutter view of the world, Lisa, and whether you should be worried about reinvestment risk in this bond market, and we'll throw in a little bit of China into the mix as well.
Can we come up with new nomenclature? Can we come up with some new phrases?
Sure, what would you like?
It's like, the new normal, or I don't know, I guess that's not new. I'll have to think about it. Okay. I'm going to come up with something
Give
new.
Thought. I'm excited for tomorrow morning.
I'm going to unveil my new stage.
Nice. From New York, this is Bloomberg.
Just moments away from the latest housing data at a time where people are wondering when will the resilience, when will the strength in a lot of aspects of the U.S. economy. And what we're seeing right now is not a lot of drama after several weeks of losses. Just to give you a sense, so far this month, the NASDAQ is down 4.9%. Apple shares down 9.5%. Today, they're little changed, although the S&P a little bit soggy as the session grows older, down 0.1% ahead of the open. We can see the euro gaining just a touch for the dollar, but still in that 109 range. And yields now up for almost 4.22% on the 10-year. Right now, we are getting some housing starts and building permits. And what they show is surprise, strength, resilience, upside surprise in housing starts coming in at 1.45 million versus the 1. It was basically in line. I mean, it's just a slight touch higher. And we're also seeing a bit of a downside surprise on building permits. This comes as this has been an incredibly hot area with gains in terms of home builder stocks rising about, 47% or something so far this year. When we take a look at the revisions, a bit of a downward revision to the prior month for housing starts, a bit of an upward revision for building permits, so pretty much a wash. But what we can see is this ongoing continued focus on creating inventory at a time where there's utter stasis in the housing market. Why would you leave if you have a less than 3% mortgage? And that has been something that has been a theme. We did see in the retailers strength, particularly in TJ Maxx, as retailers that cater to the off-brand market do continue to gain disproportionately, and the shares are gaining there. And it raises this question, what will it take for this strength to come down? Will it come down naturally, a sort of immaculate disinflation, or will it take higher rates and some sort of recession? Kara Kadana has been brilliant on this point, chief U.S. economist at BNP Paribas, who has been talking about how he will expect inflation to keep coming down, which it has this year, and that there can be some relief from the Fed to move away. Carl joins us now, I'm so pleased to say, a good friend of the show. Carl, what's your take on the resilience, just starting with the housing market, that we continue to see there?
Well, as we look at this morning's numbers, I think when housing starts tell you one story and housing permits tell you a slightly different story, permits are the one you're supposed to trust because housing starts can be very volatile due to weather and other types of factors that cause some choppiness on a month-to-month basis. The housing data have been in a pretty sour environment for the last several quarters. The pace of decline is slowing, but with affordability as low as it is and mortgage rates hitting new highs on a daily basis almost, I think these are some real constraints going forward. Of course, the inventory shortages that you highlighted are a big factor supporting activity, especially encouraging new construction. But even yesterday in the home builder sentiment survey, we saw that prospective buyer traffic is extremely low. And home builder sentiment declining for the first time this year.
So extrapolate that into retail sales. Are you saying that you're seeing similar signs that it cannot continue to have the same kind of robust gains in consumer spending that we've seen?
Well, Lisa, I see some significant headwinds emerging for retail sales and consumption more broadly in the back half of this year. Now, as we dissected yesterday's retail sales data for July, and maybe Amazon Prime Day helped to support the numbers and whatnot, but as we went into the details, it looked like discretionary spending was particularly strong. So the sporting goods, hobby, leisure, restaurants and bars, all the things you would spend on if you have extra cash in your pocket, those categories were actually the strongest categories in the report. So things are on a solid footing in the month of July at least. But as we go into the back half of the year, we know that labor activity is slowing. We know that income generation from labor activity is decelerating as well. We have student loan payments resuming in October, so there's questions whether people will immediately jump back into paying those loans or not. But with an annualized price tag of about $100 billion, it could have a very significant consequence, even if it isn't fully felt in the initial months. You have a potential government shutdown coming in the back half of the year, and also all those excess savings generated during the pandemic have been getting spent at a pretty healthy clip, whereas we think the kind of excess savings will be fully exhausted by the end of the year. And as we look by income quintile, we can see really the lowest 3 quintiles. That's a significant share of the population. The lowest 3 quintiles have basically exhausted those savings already, which should mean more price sensitivity among consumers, which helps on the inflation side, but also a slower pace of consumption as well.
Carl,
we're not there as of July, but that's something we're watching for in the back half.
People have been saying this for a while, and then you see house after house push out their forecast for recession and say, well, maybe it's not happening as soon as we thought. Can you give us a sense of what gives someone conviction that it will eventually happen, even though month after month, everyone had expected some of these consumers to run out of cash by mid-year? Now it's the end of the year. Maybe it's early next year. When does it sort of start to shift to, okay, maybe this is sustainable?
Well, I think that, as we see new data coming in, there has been more resilience in the labor market than a lot of folks anticipated earlier this year. Jobless claims, we've had a few false starts where they've started to back up, and it looked like maybe there was some deterioration in the labor market, and then kind of the numbers came right back down and whatnot. So, those kind of like canary in the coal mine moments proved to be false flags in the past. But if we look at the broader trend, we do see that it is slowing. So as nominal GDP growth decelerates, as payroll gains decelerate, this does change a lot of dynamics in the economy, including corporate profit trends, which as corporate profits decelerate, that has an implication for both capital spending plans and also hiring plans. You still have a tightening of financial conditions or of lending conditions from the banking sector that we can see showing up in the Fed surveys, banking surveys, bank earnings, et cetera, et cetera. So there are some problems that are becoming pretty intense headwinds in an economy that's slowing already. But getting the timing right has been problematic for forecasters more broadly. I don't think we're at the point where you're supposed to throw the recession call away and it's kind of immaculate disinflation and a soft landing for the economy. I'm still skeptical that we'll really be able to pull that off because monetary policy, as we know, is a very blunt instrument. And so kind of finessing the landing to have no contraction is something quite unprecedented. And so I would be surprised, given the speed with which the Fed tightened policy, if we can nail the landing, given the uncertainty over lags and the net impact.
So do you think, Carl, just to sort of underscore what you're saying, do you think that right now bond markets have it wrong with a 4.2% yield on a 10-year? Do you think that people are getting over their skis in terms of how high rates can be and how long the economy can be strong?
Well, ultimately, those longer dated yields are going to be a function of real growth in the economy and inflation trends. So if you think that there's a kind of a persistently higher inflation trend over the longer run, then you can make a case for 4% or higher on yields. We do think that we will see some pretty impressive cooling of inflation pressures over the next several quarters. We think inflation will be back to target by the end of next year. And I think that maybe part of that higher inflation for longer camp may have to revise some of those estimates as we see the economy decelerate, the labor softening, and a lot of these inflation categories moving in a favorable direction. The rent story alone is a big factor for the inflation profile. That's coming down. That's a very big component of the CPI or the inflation basket that's decelerating. You have goods prices showing further signs of moderation. So the real question will be the labor market dynamics. And if we do get some softening of labor conditions and wage pressures coming down, then I think that might alleviate some of those inflation concerns, which then could factor into where longer term yields are headed as well. So I don't know that they're getting the story totally wrong, but maybe assessing it as being a little bit too hot at the moment.
Just real quick, Carl, what's the one question that you want answered by Jay Powell next week at Jackson Hole?
I'm very curious, given the theme is structural changes in the global economic outlook, to watch the degree to which this might be setting the stage for changing inflation targets or things of that nature. Now, this is the conference or the symposium is put on by the Kansas City Fed, which is notoriously hawkish. So this may be a way of kind of chopping down the straw men before they can even get any firm anchoring. So rather than saying there are structural changes and we should change the inflation target, they can say, well, there's our structural changes, and But these are the reasons why we don't think we should be changing longer-term estimates for growth, inflation, or inflation targeting.
Cara Cadano of BNP Paribas, thank you so much for being with us. As always, we are looking at a little market reaction to that housing data as people see it as consistent with the theme that we've been hearing about, with relative strength, relative resilience, albeit slight cooling around the margins. We have been talking all morning about a fresh report from Bloomberg's Sri Natarajan and Sonali Basak on the future of Goldman Sachs CEO David Solomon and his possible successor. Something that is of great interest to Wall Street. President John Waldron is the person in question. They wrote, quote, as bitterness festers in the ranks this year over Solomon's leadership, Waldron is being pressed by colleagues to pick a side, beat his own path to win over disgruntled executives, or risk being seen as an affable clone of the CEO. Sonali Basak joining us now. Sonali, a really interesting development on the heels of a whole host of reporting. What has the response been like? What is the support for a John Waldron-led Goldman Sachs at a time where there are a lot of questions around the current leader?
Yeah, those questions around the current leader have drawn a sharp eye on John Waldron, and the tough spot he's in is that this unrelenting loyalty and intense drive has really been a hallmark of his personality. So this tension to break with David kind of goes against that, doesn't it? And you have not seen John break with David, but you have to remember something interesting. When the investment bankers kind of came and took over the top of Goldman Sachs, David and John, the traders do, by and large, love John. And so he has won the hearts of the inside of the firm as well, largely, as well as the client base. And we have a few of them quoted in our story as well. It's his style, Lisa, his kind of down-to-earthness that clients have really related to. You think of Stanley Druckenmiller, for example, saying that John Waldron is blue-collar, from the Midwest, down-to-earth. And that is what they're relating to relative to David's more abrasive style.
So he's trying to keep that popularity as he moves toward a pretty tumultuous time. I feel like this is the topic of discussion because it's a slow summer. Is that at all what's going on?
Well, it's kind of in a story that's been under the surface brewing for months. And the natural thing is, with so much pressure on David, to look at the number two. Remember, John Waldron has also been in charge of the strategy. And the clock is ticking. We've been talking about this for the last couple of days, that we're halfway through the third quarter here. And they really need to figure out this consumer business. They need to bite the bullet. They need to figure out how to make these changes in order to save themselves from another tough quarter. We're going to come back from Labor Day, and very quickly we're going to head into another earnings season. And Goldman has to put up better results than they've been putting up the last couple of quarters. They all know that. And that is largely under John's purview as well as David's.
If you're just joining the program, we are seeing a bit of a reversal in S&P and NASDAQ futures, with the S&P lower by about 0.1%. Sonali Basak, you talk about succession plans, and this is really the curious thing to me. We've seen increasing numbers of firms come out with succession plans recently. There has been a changing of the guard in the post-pandemic era, particularly in private equity, in a lot of different firms. We've seen that at Morgan Stanley. Is Goldman Sachs ready, or has there been too much turnover already for people to be saying this is the natural progression of things?
The question about John taking over one day, whenever that would be, there's an interesting question underneath the surface. They've lost a lot of people. We've talked about this a lot. What becomes of Stephanie Cohen? What becomes of Julian Salisbury? What becomes of the existing partners like Mark Nachman, Jim Esposito? There's a lot of tension. There's a lot of heated competition in terms of taking the top spots of these jobs. You look over at Morgan Stanley. They have not yet named a new CEO, even with James Gorman saying he would step down in a year. And that race is also quite intense. And you're watching James Gorman also try to make that as smooth as possible and retain whoever might not get that top spot. And so you are seeing kind of a changing of the guard, and it's not easy. It's often messy, and it also leads to very material changes in how these businesses may operate moving forward.
It's a changing of a guard, perhaps in a changing of an environment, a sea change in terms of interest rates and where they will end up. Bloomberg Sonali Basak, thank you so much. As we try to reimagine, reconfigure investment banking in an era of significantly higher rates, and that's been something a lot of people have been talking about. Coming up, we're going to dive into the housing sector. Skylar Olson of Zillow joining us to talk about how long housing prices can stay put, even with mortgage rates where they are.
When you think about the headwinds of rising interest rates, you have student loans that are coming up in October. The average household has $6,200 of expenses, and you're going to get an increase of 3 to 8% of spend coming from student loans on top of that. There's less to go around. And so that's why there's the focus on essentials and a reduced focus on some of the aspirational items.
Trying to understand some of the strength that we've seen in retail sales across the board, both this morning with TJ Maxx and to some degree Target, as well as yesterday's data. That was Dana Telsey, Chief Executive Officer and Chief Research Officer at Telsey Advisory Groups. We are about 44 minutes away from the opening bell here, and we do see a little bit of calm deteriorating as the session grows older. Not a lot of drama, just a slight softening after yesterday's softening, after what we've seen over the past couple of days. Really led by the bond market with yields higher across the board, but particularly on the long end. Again, not a lot of drama today, but how far we've come is dramatic. We have seen about a 25 basis point move in the 10-year yield so far this month. We've seen about 31 basis point moves upward in the 30-year yield as people game out higher for longer, how long this economy could sustain higher rates. One of the big question marks underpinning that has been the mortgage market, has been the housing market, which we have seen hang in there. The surprising ramification of higher yields is just less mobility. And all of a sudden, inventory is scarce and it pushes prices even higher. How long can that go on? And where does that leave rental prices that have been one of the main inputs into headline inflation? Joining us to discuss all of this, Skylar Olson, Chief Economist at Zillow. And Skylar, I want to start on the rent part because that has been a huge mystery. Are you surprised that we get a different message from everyone about where the direction of rents seem to be going?
No, not at all. I mean, this is an incredibly challenging space to do research in. Rent is not a public record. So when you hear data out in the world about what's happening to rents, it's a lot of research shops like Zillow forming data from our rental listing market. So Zillow has a massive and diverse rental market from single family to multifamily. When we report on rent, what we're doing is we're pairing the same listing and then looking at that change of price. So it's a repeat rent index, kind of like a Case-Shiller home price index. Looking at that kind of formation, we have rent slowly trending down and actually hitting negative in a seasonally adjusted way. But when we're looking at the course of, seasonal patterns, that's also, what that data set looked like back then. It's such a hard kind of space to do analysis. That said, I think we are noticing softer pressure than pre-pandemic. That should be a good sign for general inflation to continue coming down.
Okay, so just to build on that point, this has been one of the main reasons why people say that inflation is going to inflect lower because rents are coming down and the housing, the owner's equivalent rent will also continue to be either a real tailwind for this disinflation trade. How much, and you're crossing your fingers there, I can see, how much do you buy this? How much do you believe this is sustainable versus just a cooling down after the incredible run-up that we've seen in rents over the past couple of years?
Yeah, well, it's interesting that you say sustainable, right? Because rents and how they change over time is going to matter a lot for the supply picture as well. For a while, we had seen multifamily permits kind of continue at an elevated space. And we've seen that pull down as well as the completes have finally been delivered in the multifamily buildings. We had such large rates of under construction, so many apartment buildings under construction, but it takes a while for those to actually be delivered. Over the last couple of quarters, that's when we started to see an elevated number of completes in this space, but then we saw permits come right back down. So in terms of how long will we see soft rent without going into a recession, there's so much uncertainty on that end. I don't know. I mean, we could see it stabilize again at just a, steady and slower pace as opposed to falling.
Moving from rents to just simply home prices, I'm curious what you're seeing currently in terms of how people are purchasing properties. Are they incurring a mortgage rate of 7.1 to 7.5%? Or are they buying still in all cash? Are they buying with a loan from the developer? Are they staying away from previously occupied homes exactly because of the mortgage question?
Oh my gosh, all of the above. From research from Zillow Home Loans, we know that more than half of buyers are buying down points. So That's probably your first and most obvious strategy. We've also seen, new home sales perform so well. You can see that people are turning to that kind of inventory, while new listings falling into the market remains close to a third below where it was pre-pandemic. I think what we're watching and observing, if we talk home prices, is demand, at least enough fundamental demand, getting creative and making it work and pushing forward. If I took the most recent seasonally adjusted month-over-month growth in our Zillow Home Value Index, that annualizes out to a pace of 7% nationally. That's pretty darn strong. It has everything to do with a pullback in that supply side as well.
So how sustainable is this? And this is something we were talking about with a guest a couple of days ago, where they were saying that if you take a look at the affordability of these homes for the average individual household, it looks less and less affordable, especially with mortgage rates where they are. And that in order to bring things back into a balance as they were pre-pandemic, you'd have to see a 30% decline in some of these valuations. Why have we not seen that? Is it just a supply and demand? Is that sustainable? Or is there something unhealthy about this dynamic?
Yeah, so this idea of sustainability also kind of flows through like, what are the market signals that are going to pull people in and out? The reality that I'm seeing from my, we're very sensitive to thinking about the inventory side of that picture, operating, a for sale marketplace. And so that's a big part of our forecasts. When we forecast out new listings, that's a challenging picture if rates remain high. And so our forecasts also maintain this pace. If we think about what that means for affordability, right, I think there are a few things. One, I almost never show a graph anymore about the share that you would need to spend on a mortgage payment without showing you the difference between if I'd had 10 or 20% down. So some people, will take much longer to lower that dead loan and achieve affordability. Some people still also think, rates could come down. There might be consensus that it could come down in years to come, but that path that it will take there, as we've seen over the past couple of weeks, clearly incredibly uncertain. It just all comes back to supply. We just, for prices to come down, competition would have to ease up. And there's simply too much of that fundamental demand moving forward to make it work, and no supply entering the picture.
There's a theory that if rates were to come down, and we are seeing mortgage rates at the highest levels since 2001, if they do start to come down, you will actually see inventory loosen up, that people might be more willing to sell or to buy a new home and to move out of their old home. Do you think that counterintuitively, if rates go down, we see housing prices go down as well, because simply there is more supply?
That is an interesting idea. And, honestly, for housing prices to come down a little bit, I don't think would be bad for the whole system, because we are sitting on top of record amounts of home equity. When I think, what's going to happen, and I think you're right, I think rates don't even have to come down too much to unlock some of these would-be sellers. We ask, every quarter, existing owners, do you intend to sell over the next 3 years? Consistently, that was 16%. Over the last 2 quarters, that popped up to 19, and then up to almost a quarter of existing owners wanting to sell their home in the next 3 years. I don't think you say that if you're deeply, deeply, deeply locked in and aging in place. That we also saw from that survey, owners with mortgage rates above 4% are twice as likely to fall into that group. So a bit of relief could unlock supply. That's something I certainly hope for, and I think would be actually a very healthy injection into the for sale market.
Just 30 seconds, that's all I have left. I'm curious, Skylar, do you think that housing prices can sustain where they are if rates remain at these levels for 5 years?
Likely no. I think they should get softer. The inability, I think, to continue to bid, at the very least, if that is the reality, we would see a much, much lower homeownership rate. Let's put it that way.
Skylar Olson of Zillow, thank you so much for being with us. And one of the key drivers of what people look at as surprising strength in the U.S. economy, counterintuitive strength, I would add, actually, considering what people had expected higher rates to do to property prices. Coming up on Balance of Power at 5 p.m. Eastern, Wally Adeyemo, Deputy Secretary of the U.S. Treasury, as the Biden administration does a PR tour for the Inflation Reduction Act. In the markets, you do see a bit of softness as we look forward to what higher rates mean for earnings. This is Bloomberg.